Will come to order. Without objection, the chair is authorized to declare recess of the committee at any point. Pursuant to Committee Rule 3 and House Rule 11, the chair may postpone further proceedings today on any vote relating to any matter under consideration during today's markup. Before we begin, I want to mention that in light of the most recent guidance from the Office of the Attending Physician sent out just yesterday evening, masks will be required throughout today's markup for all members and staff, regardless of vaccination status, and will be enforced as a matter of decorum. Members are permitted to remove their masks only when under recognition by the chair for purposes of debate, and are expected to immediately replace their mask upon finishing their remarks. I will remind members who do not wish to wear a mask that they are able to participate virtually in today's markup via WebEx. We will be collecting and distributing amendments electronically as well as physically to ensure all members have access to relevant documents in this hybrid format. All amendments must be submitted to the committee email provided in the meeting notice. The amendment will then be distributed to all members in the room and all members on the platform through an email list that was developed in advance in coordination with the ranking member. As is the chair's practice, amendments that are pre-filed will be given priority consideration. With objection, all members will have 5 legislative days within which to revise and extend their remarks and to submit additional materials to the chair for inclusion in the record. I now recognize myself for 5 minutes for opening remarks.
I'm sorry, I thought.
Do you have it? Since the start of the 117th Congress, this committee has marked up 21 bills and has held 5 markups. Today, this committee will mark up 11 more bills. As chairwoman of this committee, I'm so very pleased to advance many strong pieces of legislation that Democrats on this committee have introduced to bring relief to millions of Americans and to create a foundation for a stronger and more sustainable economy. Today, committee Democrats will continue to take a proactive approach by introducing a range of bills, including legislation that preserves housing rights and affordability of manufactured housing communities, legislation that ensures every household has the information they need to exercise their right to vote, and legislation that addresses the GameStop volatility from earlier this year to better protect investors and strengthen market integrity. During the first of a series of 3 hearings that this committee held on GameStop and related market volatility, we received testimony directly from those involved, including from the CEOs of Robinhood, Melvin Capital, Citadel, Reddit, and a retail investor. In the second hearing, the committee heard from a panel of experts who examined the critical issues and offered policy recommendations. And in the final hearing of the series, the committee heard from SEC Chair Gary Gensler and the heads of FINRA and DTCC to hear directly from regulators on how they were responding to the market volatility. Today, we will be marking up several bills based on what we learned in those hearings. My bill, entitled the Short Sale Transparency and Market Fairness Act, seeks to address the problem of information asymmetry by providing the SEC with the authority to increase the frequency of disclosures Wall Street, hedge funds, and other large asset managers must make from quarterly to monthly. It also expands the types of information disclosed, including derivatives. Representative Casten's bill would require the GAO to conduct a robust study on the positive and negative impacts of the gamification trend of online trading platforms. Representative Sherman's bill will require a study of the practice and conflicts of payment for order flow. Finally, Representative Green's bill will make it a criminal act for market makers to trade ahead of their customers and will hold a CEO personally accountable if they trade ahead or engage in insider trading. This committee will continue to focus on ensuring that we have strong investor protections in our markets and that our financial system is fair. At today's markup, we will also consider bills Democrats on this committee have introduced to build a more fair and inclusive financial system, including legislation to promote the formation of new and diverse depository institutions led by Vice Chair Auchincloss, legislation to preserve and maintain affordable manufactured housing communities to benefit residents, led by Representative Axne, legislation to bring needed transparency and reforms to the $6 trillion family office industry, led by Representative Ocasio-Cortez, legislation that finally puts an end to LIBOR, the reference rate that Wall Street and other global markets manipulated at the expense of municipalities and consumers, led by Representative Sherman, and legislation that provides tenants and mortgage loan applicants with information on how to register to vote, led by Representative Williams. Finally, I'm pleased we will also be marking up two bills led by Republican members of our committee, Representative Huizinga and Representative Wagner. I would like to thank the members for their tremendous work on these important bills, which I look forward to passing through this committee. I now recognize the ranking member, Mr. McHenry, for 5 minutes for any opening remarks he may have.
Well, thank you, Madam Chair. I'd like to first thank the chair for her prompt response to my letter urging inclusion of Republican bills in this markup. There are two Republican bills on today's roster. Mr. Huizinga's Small Business Mergers, Acquisitions, Sales, and Brokerage Simplification Act of 2021, and Ms. Wagner's Financial Exploitation Prevention Act of 2021. These represent bipartisan achievements, and I'm glad they're on the docket. Each of these bills reflects good, sound policy. H.R. 935 ensures that small businesses are not forced to waste already scarce resources on burdensome regulations, resources that can be used to employ additional workers to make capital investments. And H.R. 2265 takes another step towards stopping bad actors who want to exploit seniors or otherwise mentally or physically impaired Americans. This committee has been focused on addressing elder fraud, so I thank the chair for including this bill. I thank the Vice Ranker, Ms. Wagner, for her work to combat financial exploitation. These bills, along with H.R. 4590, the Promoting New and Diverse Depository Institutions Act, introduced by Mr. Auchincloss, demonstrate that Republicans and Democrats can work together on sound policy. And I wish I could end my remarks there. But the rest of the bills attached to today's markup are not bipartisan, nor do I believe they're based in sound policy. This committee held 3 hearings earlier this year to examine the so-called GameStop saga. Democrats have a list of bills on the agenda today that, quote, respond to these events. This is a missed opportunity. Today, we'll consider a bill on payment for order flow. On its face, the bill is just a study. In reality, it's Democrats' attempt to get one step closer to banning payment for order flow, a practice that the Securities Exchange Commission has long allowed and has helped lead to commission-free trading. We'll consider a bill to, quote, create greater transparency with respect to 13F disclosures. Yep, this is what this is in reality is a significant expansion of the 13F reporting regime for topics that the SEC has either already addressed or has the authority to address. We'll consider a bill that prohibits trading ahead trading ahead by market makers, even though the practice is actually already illegal. There is no ambiguity on this point. And the Securities Exchange Commission and the Department of Justice have the authority to pursue and prosecute bad actors, and they do. Instead of coming up with half-baked solutions for perceived problems, we should be working together to empower everyday investors to make decisions that are in their interest. Policies like the accredited investor definition blatantly pick winners and losers, and if you're wealthy, you're good to go, and if you're not, the government, well, has to protect you out of opportunities. We should move away from this outdated investment regime. In fact, today Republicans will introduce a series of bills that expand investment opportunities for everyday Americans, directionally quite different than what we have on the markup today. It's time that we get serious about equity and ownership in the American economy. Finally, Madam Chair, we'll mark up H.R. 3332, a bill that authorizes $500 million over the next 5 years for manufactured housing. I don't think I need to remind my colleagues that according to the National Low-Income Housing Coalition, we have a 5-alarm fire on our hands. The eviction moratorium expires this week. Less than 7% of the $46 billion in emergency rental assistance has made it in the hands of families in need. This is an abject failure. Instead of marking up Republicans' Renter Protection Act, which gets the $46 billion appropriated by Congress to renters immediately, Democrats want to focus on authorizing $500 million for manufactured housing. I'm sorry to say the Democrats' priorities here don't add up. So I'll end where I started. I appreciate the chair's willingness to include Republican bills on the agenda, and I look forward to working with you, Madam Chair, and the committee Democrats on solutions that are grounded in sound policy. And with that, I look forward to today's markup, and I yield back.
Thank you, Mr. McHenry. Pursuant to notice, I now call up H.R. 4590, the Promoting New and Diverse Depository Institutions Act. The clerk will report the bill.
H.R. 4590, a bill to require the federal banking regulators to jointly conduct a study and develop a strategic plan to address challenges faced by proposed.
Without objection, the first reading of H.R. 4590 is dispensed with. The gentleman from Massachusetts, Mr. Auchincloss, the sponsor of the bill, has an amendment in the nature of a substitute, copies of which have been distributed in advance to all members and are also on the dais. The clerk will read the amendment.
An amendment in the nature of a substitute to H.R. 4590, offered by Mr. Auchincloss of Massachusetts. Strike all after the enacting clause and insert the following. Section 1, short title.
Without objection, the amendment in the nature of a substitute will be considered as read and considered base text for the purpose of further amendment. I now recognize the gentleman from Massachusetts, Mr. Auchincloss, for 5 minutes to explain the bill.
Thank you, Chairwoman Waters. I'm excited to talk about this bill, the Promoting New and Diverse Depository Institutions Act. I think all of us here on the Financial Services Committee can agree that consumers should have access to affordable, high-quality banking services as one pillar of lowering costs for working families. To ensure affordability for consumers, there must be competition in the market. Over the last several decades, there has been consolidation amongst banks and credit unions. This has effectively limited the products available to consumers and has artificially driven up costs while closing bank branches for people who already did not have many choices. In my own home state of Massachusetts, for example, there's only been one new charter of a bank in the last 10 years, while there have been series of mergers and acquisitions that have limited choice and competition. My bill, the Promoting New and Diverse Depository Institutions Act, is the first step to address this. It directs the banking regulators to work together to address the challenges that new depository institutions face when applying for a charter. Starting and maintaining a new bank or a credit union is hard work. It is the banking regulators' responsibility to measure and mitigate the challenges that new banks face. However, based on the decreasing number of new banks, not enough is being done. Additionally, the bill specifically asks for a plan that takes into consideration the challenges faced by minority depository institutions, MDIs, and community development financial institutions, CDFIs. MDIs and CDFIs play a unique and vital role in our financial system and often have a close relationship with their consumers. This was prevalent during the coronavirus pandemic. MDIs and CDFIs were able to quickly get PPP and EIDL funds to their consumers where they already had close relationships built on trust. I am hopeful that this bill is the beginning of a conversation to ensure that Americans in banking deserts have access to affordable banking services and that consumers everywhere can benefit from choice and competition. I'm also pleased that this bill has bipartisan support from Congressman Green and Ranking Member McHenry, and I ask for support from the rest of my colleagues. Thank you, Madam Chair. I yield back the rest of my time.
The gentleman yields back. Is there further discussion of or amendments to?
Madam Chair,
Madam Chair.
Who seeks recognition? The gentleman from North Carolina is recognized for 5 minutes.
Well, thank you, Madam Chair. First, I want to move to strike the last word. Since the Dodd-Frank Act was enacted, the number of community and financial institutions has steadily declined in America. And this is due to increased regulatory and compliance burdens. The loss of local banks and credit unions has disproportionately affected rural communities. And establishing new banks and providing greater access to credit can fill the need left by bank consolidation and branch closures over the past decade. This bill recognizes these challenges and the need for more de novo charters. It directs the banking agencies to study ways to promote the establishment of new banks and credit unions, including community development financial institutions and minority financial institutions. This bill is a step forward in making banking more available, particularly for rural and underserved consumers. And I want to commend the new member of our committee, new member of this body, for his work in crafting this bill, and also being open to input from the minority party on helpful changes as we saw it, and the willingness to work across the aisle. So I want to commend Mr. Auchincloss for his work there, and creating a very good bill that fits a great need across the country, both in urban areas, but in particular, rural areas of America. And so thank you so much for offering this bill, Mr. Auchincloss. And Madam Chair, I urge our colleagues to support it. Happy to yield to my colleague who wants to, happy to yield back. Urge its adoption. Yield back.
The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes to strike the last word.
I move to strike the last word. Thank you, Madam Chair. Let me first start by thanking my friend from Massachusetts, Mr. Auchincloss, for recognizing a problem that I've been focused on for the last five or so years. The dearth, and my colleagues have heard me talk about this for several Congresses now, the dearth of de novo bank charters and the declining competition through consolidation, as my friend from Massachusetts has recognized. And I will support the gentleman's bill because he recognizes the problem that we've been seeing for quite some time. And while I plan to support the gentleman's bill as it seeks to address a shared goal that we have, I am not sure that another study is sufficient for the circumstances. To date, we have studies by the Fed, the FDIC, and other regulators already completed. And those studies have observed the dearth of de novo formation and identified the challenges facing underserved areas, including rural communities like those in my district. I'm happy to share with my friend from Massachusetts those completed studies that have been already done. I appreciate another study if we want another study, but we've got a lot of studies that are collecting dust on the shelves. I worry that another study would not be completed and published for another 18 months would merely serve to unnecessarily delay the solution to a very urgent and time-sensitive problem. I maintain we can do more. My bill, H.R. 2561, that I've introduced now for 2 consecutive Congresses, the Promoting Access to Capital in Underbanked Communities Act, provides a series of solutions to the problems that Mr. Auchincloss's bill wishes to study. It is a relatively straightforward bill that directs regulators to phase in capital requirements for de novo institutions, makes minor targeted regulatory adjustments to help underserved rural areas, and includes several other common sense provisions to promote bank access in unbanked communities. The bill is based on a bipartisan concept, first raised by Mr. Meeks in a markup last Congress when he proposed to phase in capital requirements for new minority depository institutions. He and I had a productive exchange during that markup where I offered the idea of applying that concept more broadly to all de novos to ensure that no community is left behind. The remaining substance of the bill came to fruition after I read a November 2019 Fed study on and underbanked communities. I think the Fed, as one of the regulators in Mr. Auchincloss's bill, would probably just regurgitate the same findings and conclusions that it's already published. The report identified 44 counties considered deeply affected by trends in bank closures and consolidation, which it defines as counties that had 10 or fewer branches in 2012 and lost at least 50% of those branches by 2017. 89% of those identified deeply affected counties are rural counties. I represent several of those counties, as do others on this committee, including some of my colleagues on the other side of the aisle, most notably Mr. Lawson, who has had a very productive engagement with my office on this bill. So I commend the gentleman from Massachusetts for his work on this bill. I'm happy to support this study, but I would invite him, and I would especially invite the chairwoman of the committee, since she's also identified this as a problem, and other members of the committee interested in this topic, to collaborate with me on this issue. My bill will actually take the steps needed to address the problem. My bill would actually implement the solution to the problem. It would actually start solving the problem as opposed to continuing to study the problem. I ask for unanimous consent to insert in the record support for my bill, H.R. 2561, from the Independent Community Bankers of America and the American Bankers Association. And I'll read just one piece of that letter from the ICBA. The provisions above in my bill, the BAR bill, would provide more regulatory capital and lending flexibility, which will facilitate the creation of de novo banks, encourage investment in these banks, and promote their viability. Excessive regulation is a burden for all community banks, but it presents a special challenge for de novos that must dedicate their resources to establishing a foothold in their market and achieving viability. H.R. 2561 will promote more competition in rural markets for financial services, expand access to credit, and support the economic vitality of rural America. And so I ask unanimous consent to insert in the record those letters of
Without
support.
objection, such is the order.
Thank you. And in conclusion, the gentleman from Massachusetts said not enough is being done. I wholeheartedly agree. I commend the gentleman from Massachusetts. Not enough is being done. So let's move on and actually implement the solution to the problem. And with that, I yield back.
Thank you very much. I now recognize myself for 5 minutes. I support H.R. 4590, the Promoting New and Diverse Depository Institutions Act, sponsored by the Vice Chair of the Committee, Representative Jake Auchincloss. Since the 1980s, we have seen consolidation in the number of depository institutions we have. We went from having roughly 18,000 banks and 15,000 credit unions in 1985 to about 5,000 banks and 5,000 credit unions today. Over the last decade, we've also seen a reduction of 3,300 branches by the 4 largest banks, leaving behind banking deserts where residents lack access to a nearby branch for basic banking services. I've also been troubled by the recent decline of roughly 1/3 of all minority depository institutions, referred to as MDIs, and more than half of Black-owned banks since the 2008 financial crisis. I, along with other members of this committee, including Representatives Meeks, Green, and Beatty, have advanced legislation to support MDIs and CDFIs. And last December, I was pleased to work with Ranking Member McHenry and Senators Brown, Crapo, and Warner to reach a bipartisan deal to provide $12 billion in capital investments and grants to support existing MDIs and CDFIs. The bill we're considering today builds on those efforts to address a different concern. Very few depository institutions, especially MDIs, have been newly chartered in recent years while banking deserts grow. While some point to regulatory cost for this, researchers from the Fed, among others, point to non-regulatory factors like the low interest rate environment as challenges for those seeking to form a new bank or credit union. Nevertheless, our regulators have yet to do a comprehensive study that could help identify legislative recommendations for Congress to consider that would encourage the creation of new and diverse depository institutions. Regulators also lack a strategic plan to encourage the creation of such institutions, including MDIs or institutions that could be certified as CDFIs. Therefore, I'm pleased this legislation requires those initial steps to be taken and that regulators must do so in a manner that allows the public to fully engage and provide their own comments and suggestions on the study and strategic plan. I thank Vice Chair Auchincloss for his good work on this bill, and I urge my colleagues on both sides of the aisle to support H.R. 4500. I yield back the balance of my time. The gentleman from Wisconsin is recognized for 5 minutes to strike the last word.
Thank you, Madam Chairwoman. I rise. I'm in support of my my colleague, Mr. Auchincloss's bill here, but I really start to wonder: is anybody reading these studies? I don't think the answer here that these studies are going to find is going to be all that darn creative. I think you noted it yourself, Madam Chairwoman, in your comments. We have a regulatory environment that causes challenges. We have a low interest rate environment. The way we're spending money in Washington, D.C., the way we're seeing early indications of inflation, the way we're seeing rising costs, that might address the interest rate. I don't know that that's a good thing for the country, but we can park that conversation for another time. What we control in this committee is definitely the regulatory environment. As you look at what came out of Dodd-Frank at a period of time where, before I was here on this committee, but at a period of time where this committee put forward significant regulations that were not tailored to the size, scale, and scope of the institutions they were regulating. I think we have an obligation in this committee to go back and in particular to right-size the regulations, in particular for our community banks. It's critical in rural areas in this country. It's critical in some of our more challenged urban communities as well that are not as well served as I think they could be if we in this body spent the time to go look at the regulations, find ways to reduce the burden while still protecting depository institutions, still protecting folks. I think my colleague, Mr. Barr from Kentucky, spoke eloquently about the ability of us to really go and look at what we can be doing to right-size these regulations, to allow our community banks to be able to go and address some of the biggest challenges we're seeing. We're seeing mergers and acquisitions in this space many times because compliance departments of smaller community smaller community banks can't keep up with the large depository institutions that we have in this country because this committee, the United States Congress, have placed regulatory burdens upon our community banks in such a manner that they find it very difficult to operate. And so they merge into larger depository institutions, which sometimes are not as equipped at serving some of our rural or more challenged neighborhoods as well as they would if we allowed our community institutions to operate. And so I'm fine with the bill before us, but I don't really know that another study that nobody apparently is going to read is the sole answer. I think we need to have some action here at working to tailor our rules and our regulations in a manner that would actually allow our depository institutions to do their job, to drive capital into our country to be able to create jobs. And Madam Chairwoman, with that, I will yield back.
Thank you. The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chairman. I move to strike the last word. And I would like to echo your comments, Madam Chairman, certainly along with Ranking Member McHenry and certainly Mr. Barr. And I want to thank Mr. Auchincloss for proposing this bill. I agree with Mr. Barr regarding his bill that I'm a co-sponsor of. I think the bill that we're debating today, when we look at the financial services industry, it looks a lot different, certainly, than it did before the passage of Dodd-Frank. In 2010, I was serving on the board of a community bank in West Tennessee. And I saw firsthand how Dodd-Frank certainly affected smaller institutions, community banks around my area and around the country. It impacted consumers in the form of higher cost. and, as we're talking today, decreased access to banking services. I don't think there's any doubt that Dodd-Frank has affected the creation of de novo banks. To a point. And, or 2010, since 2010, in Tennessee, there have been 3 new bank charters. In the 11 years prior to Dodd-Frank, Tennessee had 52 new bank charters. And of course, the lack of new financial institutions have been felt by underserved communities in my state and around the nation. We've had plenty of hearings about that in this committee. So I'm glad that as we look at the challenges, that prospective bank charters is receiving bipartisan attention today. I think it's important that Congress works together to promote new de novo charters and break down the barriers preventing their formation. The creation of new financial institutions, I think we all agree, will expand banking access to the rural communities that don't have that banking access, to the urban communities that don't have that banking access, to the banking deserts that we've talked about in this committee, those that need it the most. So I applaud the gentleman for his bill. Look forward to supporting it. And with that, Madam Chairman, I'll yield back the balance of my time.
Thank you. The gentleman from Illinois, Mr. Casten, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair, and thank you to Mr. Auchincloss for this bill. I'd like to yield my time to Mr. Auchincloss to respond to anything he'd like.
Thank you, Mr. Casten. I appreciate the support from the chairwoman and the ranking member and my colleagues on the other side of the aisle. I would say one aspect that distinguishes this from previous studies, and I do know that there have been several that have come before us, is that this is multi-threaded and it's proactive. As we know, the maze of banking regulations have many, many agencies at the table. Then the big banks are much more able to navigate those multiple touch points than the small banks are. And this study is comprehensive. It requires all of them to come together to put forward a plan, and it's proactive. They need to come back with some steps to take that will engender more de novo charters. I'm excited to question and to study this report and to look for really concrete steps that we can take in conjunction with my Republican colleagues to create more choice and competition in the banking sector. And I know that the banking groups share this excitement. It's why this bill has strong support from the ICBA, amongst others. And to the gentleman from Kentucky, Mr. Barr, I appreciate your comments, and I'm absolutely happy to work with you on some of the concrete ideas I know you've already put forward. And I yield back.
Thank you. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. I too support HR 4590, and I think that it is an important step in the right direction. Between 2008 and 2020, as we've heard said a number of times, 13,000 bank branches closed in the U.S., representing 14% of all branches. Like many in this room and many representatives in the Congress, my district has been directly affected. In fact, my home community has been directly affected, as we've lost many of the bank branches, in particular in the small rural communities that served our area. Many communities report that following a bank closure, and I can attest to this being true in my own community, they also lose financial and community resources, including financial advisors and civil leadership. Support for local organizations and local civic activities declines as those banks depart, those branches close. These losses leave communities with unanswered questions, instability, and less access to badly needed services. In addition to closures, in recent years, we have seen a dramatic decline in de novo community bank formation, largely due to increasing compliance costs and capital requirements. A study is a great first step, but I think we need more action. And so I echo the thoughts of Mr. Barr and his Promoting Access to Capital in Underbanked Communities Act, which would establish a 3-year phase-in period for new banks to comply with federal capital standards, among other provisions designed to promote and sustain de novo banking. Like my colleague from Tennessee, Mr. Kustoff, prior to coming to Congress, I had the privilege of serving for 10 years on the board of a small community bank in my community, in this case, a national bank. And I saw firsthand the destructive power of overregulation and regulations that were not carefully sculpted to contemplate the impact that they would have on small community institutions. In the case of the bank I served on, it was a nationally chartered bank, and the costs of compliance were clearly different than what we saw for state chartered banks and other institutions like credit unions. And so I think we owe it to the banking community, and we owe it to our constituents to look carefully at reassessing what the bank regulatory environment should be like. And we should be looking for ways to reduce the burden that we put on our banks, financial institutions, and ultimately that are the costs that are placed on their customers that end up resulting in less choice, less access, and reduced opportunities in those communities. In particular, I would close by just calling attention to a looming problem, which is that in the wake of the responses to COVID-19, we have seen the capital levels at banks and the assets increase dramatically, the assets that is increased dramatically. And this creates a long-term problem with respect to the regulatory thresholds that many of our banks face. I know we relaxed some of those have been relaxed through the end of this year, but I would certainly call on our regulators to take a fresh look at extending those as the asset bubble that's been created by COVID-19 response continues to be an issue. And I think that this committee should take a longer-term look at increasing those thresholds or adjusting to them to more appropriately reflect the current status in the banking industry. And with that, Madam Chair, I yield back.
Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes to strike the last word.
Strike the last word. Thank you, Madam Chair. And again, let me join with my colleagues in congratulating the gentleman from Massachusetts on his concern about an important topic and an issue that we're all concerned about and have been for years. But it is, as my friend from Kentucky says, it's not an issue that needs to be studied. It's an issue where we need to take action knowing the outcomes that are available to us in federal policy, both legislative and regulatory. And I would say, for example, one of the burdens to de novo charters are decisions taken by this Congress over a long period of time. The Regal-Neal Act in 1994, probably a good piece of legislation, reformed CRA. It has a lot of positives to it, but it authorized nationwide branching for all banks. There was no longer any reason then to have a charter. The value of that community charter dropped when Regal-Neal was passed. Secondly, this Congress has happily allowed the big banks to get bigger through mergers and acquisitions that are approved typically in times of crisis, which concentrates banking assets another way in the largest institutions of the land. And finally, as has been talked about here, we have tremendous cost increases for smaller institutions. And Dodd-Frank added to that burden. Despite its efforts to be responsive to community banks, it did raise that overall annual operating cost of banks, forcing banks to have to be bigger, have more complexity to even run the most basic of operations. And then finally, I would say, for rural banks, something that Mr. Barr and I certainly understand and represent, as do my friends from Tennessee that have spoken, the huge costs in trying to maintain service levels in our rural communities. We have many communities now that do not have a physical banking location. And people might argue, well, that's okay, because we're all on the internet now, man. We're using apps. Well, those counties also don't have broadband. They also don't even have cellular service. So it's hard pressed to say that, that physical office isn't very, very important for economic development, personnel, and touching customers in those areas. So here again, federal policy affects those rural service areas that my friend is concerned about. And this is despite CDFIs and others going in those markets. The Federal Reserve will not sell a bank branch in a rural county, to a credit union, for example, because the allegation is credit unions are not full banking. Or the Federal Reserve will not approve a merger in a rural county if there's only 3 banks and one of those other banks wants to buy the disposed of branch because of, quote, concentration. And I would argue the services to those communities far and away out exceeds that merger and acquisition definition, the so-called Herfindahl Index that prohibits even, and it's all based on what? Deposit share. It's not even based on anything that's really a market analysis recognized in the modern world of finance. So these studies that Mr. Barr has referenced, I think they're important. I think they lead the way. That's why I support the gentleman's bill, but I want everyone on both sides of the aisle here to understand how we need to move forward here with some concrete actions. Mr. Barr proposes those. I have other ideas. But Mr. Barr, let me yield to you for the minute left and talk about those studies and urge you to try to insert those in the record for our colleagues.
Well, I thank my friend from Arkansas, and once again, thank my friend from Massachusetts. I agree that we need a proactive approach here, and that's why we want to move forward with these concrete ideas. I want the gentleman from Massachusetts to also know that not only does my bill have the endorsement of the Independent Community Bankers Association, which obviously has also endorsed your bill, and I encourage the gentleman to talk to the ICBA about my bill, about the specific and concrete solutions that they have proposed that are included in my bill, also the ABA, which has endorsed my bill. But I want the gentleman to also know that we consulted with the regulators, and the regulators gave us specific ideas and actually helped us change and improve my bill. So to the extent you're looking for a comprehensive, proactive approach from, from the regulators, that work has been largely done. And we consulted with the OCC, we consulted with the Fed, we consulted with the FDIC, we shared language. They improved the language. And so, again, I think you'll find that a lot of this work has already been done. I worry about a delay of 18 months, but in any event, to Mr. Hill's point, I offer for inclusion in the record
The gentleman's time has expired.
these studies that have already been included.
The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair, and I'll allow my colleague from Kentucky to continue and to finish up.
Thank you, Madam. Thank you to my friend from Michigan. And Madam Chair, I ask unanimous consent to insert into the record completed studies from the FDIC and the OCC and the Federal Reserve that have been completed and that identify what the problem is.
Without objection, such is the order.
Thank you, Madam Chair. And just to conclude and complete my thought here, so not only have we worked with the banks themselves, not only have we worked with the trade associations in crafting the legislation that actually offers the solution, we worked with the regulators already. And the regulators have given us their suggested solutions. And so I'm not convinced that we need another study. I'm going to support another study because I genuinely appreciate my friend from Massachusetts collaborating with us, working with us, identifying the problem. Certainly another study from these same regulators is not going to hurt. It's going to just underscore the problem we've identified for many, many years. But I do worry that delaying for another 18 months action is going to result in further consolidation. It's going to result in, and inaction will result in aggravating the problem, which is that many of these rural communities in our districts will not get the de novo charters they need, will not get the banking activity they need. They will continue to see over the next 18 months, as we study this issue, we will see more branch closures. So I welcome the study, but I want us to move forward with solutions that the regulators themselves have already proposed to the Congress. These solutions that are included in our bill that the ICBA, the community banks are already telling us this is what we need to ensure new bank formation and to prevent further consolidation. And I want to thank my friend, Mr. Hill, Mr. Kustoff, and Mr. Rose for identifying these problems. And I'll conclude with this. We know what the problem is. We don't need a study to know what the problem is. There are 3,832 fewer banks in the United States today than there were in 2005. That's a 43% decline. We don't need another study. That is a fact. We already know that fact. And of the banks active today, only 34 were established after 2010. We don't need a study to tell us that. We already know that. So let's pass Mr. Auchincloss's bill, but let's also follow that up with some action to actually solve the problem. And with that, I yield back.
And reclaiming my time, I appreciate the enthusiasm on our first bill, especially one that we agree on. I can hardly wait till we get to the bills that we don't agree on. But I know votes have been called, so I will simply say I wholeheartedly agree with my friend and colleague from Kentucky. I will vote for the bill with the recognition and the understanding that I fully believe that we have sufficiently studied the issue, and we do need to pass the Bar Bill 2561. And with that, Madam Chair, I yield back.
The gentleman yields back. Is there further discussion of or amendment to H.R. 4590? If not, the question now occurs on approving the amendment in the nature of a substitute. All those in favor say aye. Aye. Those opposed, no. In the opinion of the chairs, the ayes have it, and the amendment in the nature of a substitute is agreed to. The question now occurs on ordering H.R. 4590 as amended to be reported favorably to the House. All those in favor say aye. Aye. Those opposed, no. In the opinion of the chair, the ayes have it.
Aye.
The ayes have it, and H.R. 4590 is agreed to. Thank you very much. The committee will now stand in recess, subject to the call of the chair. We will reconvene immediately following the conclusion of the 4 votes. I now call up H.R. 4618, the Short Sale Transparency and Market Fitness Act. The clerk will report the bill.
H.R. 4618, a bill to amend the Security Exchange Act of 1934 to modernize the reporting requirements under Section 13F of such act and for other purposes.
Without objection, the first reading of H.R. 4618 is dispensed with. The chair has an amendment in the nature of a substitute, copies of which have been distributed in advance to all members and are also on the dais. The clerk will read the amendment.
An amendment in the nature of a substitute to H.R. 4618 offered by Ms. Waters of California. Strike all after the enacting clause and insert the following. Section 1, short title. This act may be cited as a short...
Without objection, the amendment in the nature of a substitute will be considered as read and considered base text for purposes of further amendment. I now recognize myself for 5 minutes to explain the bill and my amendment. Earlier this spring, when retail investors banded together using social media to execute what's called a short squeeze of the hedge fund Melvin Capital, it instantly appeared to be a story of David defeating Goliath on Wall Street. Then, Robin Hood and other brokers, seemingly siding with hedge funds, imposed limits on retail investors from buying the shares of the very companies at the heart of the squeeze, leading some to claim that our markets are rigged against retail investors. One of the clear takeaways during the committee's lengthy examination of the GameStop trading events was the marketplace. Investors and companies would all benefit from increased transparency, especially by the large hedge funds and other Wall Street asset managers. My bill, H.R. 4618, the Short Sale Transparency and Market Fairness Act, provides this heightened transparency by directing the SEC to revise the frequency, timeliness, and content of what's called Form 13F. Today, asset managers who manage over $100 million, including hedge funds and other funds, are only required to file Form 13F 45 days after the end of each quarter, which essentially renders that information useless. And importantly, the filings are generally limited to the asset manager's equity positions or long positions, and not most short positions or derivatives holdings, even if they have a similar economic performance as holding the equity security. In the late 1970s, Congress directed the SEC to require Wall Street's large fund managers to disclose their assets quarterly to the markets for several reasons. It was important that the congressional record notes, number one, for companies to know who their shareholders are to better engage with them. Number two, for other investors to know where large investors are investing. And critically, number three, for Congress and the SEC to understand the economic power and influence of these funds. Today, even though the large managed funds have become more dominant in the markets and transactions occur at the speed of light, the information on the 3F filing has not changed. In addition, many large investors now use derivatives as total return swaps or contracts for difference to quickly amass large levels of shares of a company. But these positions, which didn't even exist in 1979, are now required to be disclosed. As a result, the information on a large fund's 13F form is woefully incomplete. At our second hearing on GameStop, one of our witnesses, Alexis Goldstein from the Americans for Financial Reform, highlighted these discrepancies and urged that the committee and the SEC include short positions and derivatives in 13F forms, increase the frequency, and decrease the lag of 13F reporting. My bill, H.R. 4618, does just that. This bill authorizes the SEC to require these reports to come out monthly and to update how quickly the report is due. The bill directs the SEC to complete rulemaking that is long overdue from the Dodd-Frank Act, requiring the disclosure of aggregate short positions and to include certain derivatives on Form 13F. And the bill directs the SEC to study how the large asset managers are requesting the commission to delay the release of their reports, which can undermine the very purpose of these disclosures. Without objection, I'm entering the following letters of support for the bill from the Consumer Federation of America, Public Citizens, Americans for Financial Reform, North American Securities Administrators Association, Society for Corporate Governance, National Investor Relations Institute, and the National Association of Manufacturers. With this more updated information, not only will smaller investors and company managed benefit, but the American public will be more informed of the economic might of these large Wall Street funds that could, through their corporate suffrage, set wages and cost of goods and services that directly affect workers and consumers across the country. So I urge adoption of H.R. 4618 and yield back the balance of my time.
Madam Chairwoman.
The gentlewoman from Missouri is recognized for 5 minutes to strike the last words. Ms. Wagner?
Madam Chairwoman, I move to strike the last word. This bill is a significant and unnecessary expansion of the 13F reporting regime. My friends across the aisle claim this bill is needed for situations like the Archegos saga from earlier this year, but I doubt that. The SEC recently stood up its security-based swap reporting regime, which will go into full effect this year. Had that regime been in place a year ago, it is likely that Archegos' situation would not have unfolded in the way it did, thus eliminating the need for H.R. 4618. This bill will also likely be used to attack short selling through its mandate for the SEC to complete the Dodd-Frank Section 929X short sale disclosure. It's worth noting, since the passage of Dodd-Frank more than 10 years ago, the SEC has had the authority to require aggregated short sale disclosure, and it's telling that even under 6 years of Democrat-led SECs, completing this Dodd-Frank rulemaking was not, I underscore not, a priority. Could it be that those Democrat SEC chairs believed the benefits of these disclosures were outweighed by the potential costs? After all, shorting a stock plays an important role in price discovery. It often roots out fraudulent companies like Enron and Luckin Coffee well before government regulators. The bill also fails to appreciate the risks and costs of front-running and copycatting. Disclosing a fund manager's holdings can reveal sensitive information about trading strategies. Last year, the SEC noted that 13F filings by smaller managers are more likely to be used by other market participants to engage in front-running or copycatting. While the ANS has changed some of the bill's unjustified filing requirements included in the previous iterations, it is clear that the intent here is to speed up both the frequency of reporting as well as the time between the end of period and filing. It is not yet clear if that is necessary. And finally, the ANS continues to attack confidential treatment requests. From earlier versions of the bill, we know the bill's study and mandated rulemaking on confidential treatment requests, or CTRs, is really intended to reduce the usage of confidential treatment, which will further harm smaller investment managers. For these reasons, I oppose this bill, and I encourage my colleagues to oppose it, and I yield back my time.
The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair, and I strike the last word to hopefully respectfully ask a couple of questions about this piece of legislation, and I too echo my colleague from Missouri with the improvement with this ANS, but I do have a couple of questions about the bill if the chair would indulge in this little bit of a back and forth. My first question to the chair, to the author, is regarding the frequency of those 13F and the disclosures, whether that will diminish the incentive for investment research. That's one of the concerns that I have, and I'm curious if you would acknowledge that there is the possibility that there could be a disincentive for that research to happen, and could this potentially harm the liquidity and efficiency of the markets? As ranking member of the Investor Protection and Capital Markets Subcommittee, that this idea of capital formation is key and central, I believe, to what we have to work on, and I'm wondering if you could expound on that at all.
Well, no, except to say that I am really focused on transparency and providing sufficient information for investors. I don't think it's a disincentive for investment. I think it's an incentive for investing. So I disagree with you.
Okay. Is the information required to be disclosed in the bill information that the SEC could already mandate?
Well, of course, that is the case, but I don't think that should disqualify members from Congress of having their say. Certainly, the SEC is empowered, and their mission is to protect the investors. And this they do in so very many ways. But for a member of Congress to have in legislation something that they believe is important and would even help the SEC in their decisions to protect the investors, I think it's important for us to do. I don't think we should be excluded rather, from proposing ideas in our bills because we say, oh, the SEC could do that. Let's help them out.
If you'll indulge a follow-up on that, and I'm concerned we have a 180-day period in this for the rulemaking, and I'm afraid that rushed rulemaking may actually harm the markets. And I'm falling back on a conversation that we have had collectively regarding LIBOR and the rulemaking for LIBOR taking 180 days. This is on something that we have a significant amount of consensus on, and there was concern from the rulemakers that they may not have sufficient time in that 180-day window, and I really want to make sure that this is thoughtful, short sale disclosure rulemaking, and I'm concerned about this 180-day window, and I'm curious if the chair believes that is sufficient.
We haven't heard the complaint.
Okay, as you aptly identified, it takes 180 days. I'm just told and reminded by my staff that since Dodd-Frank, it has been 11 years. So what's the question?
Well, if it's been 11 years for a number of rulemakings that has been a part of Dodd-Frank, how are we going to do this in 180 days? How are the rulemakers actually going to be able to do this in 180 days?
Well, let me just say that we don't know what has been attempted, what has not been achieved in 180 days on rulemaking in other ways, but it's our responsibility to do what we think needs to be done and to do it according to the rules and not to anticipate that we can't do it, but rather to believe that we can do it. So that's how I think about public policy making.
Okay. Well, reclaiming my time on that, I'm concerned that that may not be a realistic time frame, and I'm wanting to make sure that as we are doing something complicated, or as we are asking the SEC to do something complicated, controversial, unclear, that it be very thoughtful. With that, I ask for unanimous consent to insert two letters into the record: July 27, 2021 letter from the National Taxpayer Union opposing HR 4618, and a letter also from July 27, letter of coalition of organizations that include Americans for Tax Reform, Council for Citizens Against Government Waste, Taxpayer Protections Alliance, Pegasus Institute, Center for Individual Freedom, and the National Taxpayers Union. Ask for that unanimous.
Without objection, such is the order.
Thank you, Madam Chair, and with that, I yield back.
Gentleman
I'm
yields
sorry,
back.
I should say my opposition to the bill still remains, but I do yield back.
The gentleman yields back.
I move to strike the last
Is there
word.
further, who moves to strike the last word? Who seeks recognition?
Gonzalez from Ohio.
The gentleman from Ohio is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. I fear that the author, when I look at this bill and see the justification and hear Robinhood and Archegos as part of the justification for this bill, unfortunately demonstrates a complete lack of understanding of what happened with Robinhood and Archegos. So let's review Robinhood quickly. Robinhood halted trading, and I have a sort of a love-hate relationship with Robinhood, but Robinhood halted trading because they couldn't post their margin requirement or their deposit requirement. There was too much volume. They didn't have enough capital on their balance sheet. They halted trading. They mismanaged their balance sheet, in my opinion, and had to raise the cash and lower the requirement. And so they did that. There's nothing about this bill that, if it had been enacted prior to the Robinhood fiasco, would have prevented Robinhood. Absolutely nothing. If you want to prevent Robinhood going forward, there's really two things you could probably do. One is to discuss capital requirements for broker-dealers. The second is to shorten the settlement time from T2 to T1 or less than T1. Absent that, probably not going to be able to prevent it. And this bill, again, does absolutely nothing on either of those. Archegos, completely different situation. Archegos is actually a 13D issue, not a 13F issue. Archegos hadn't filed a 13F in 8 years due to some ambiguity, but it could be a 13D issue. Archegos, because they use total return swaps, had exposure to the underlying stocks that was greater than 5%. They didn't own the shares outright. And because they used the total return swaps, they were able to sort of obfuscate their exposure. When the underlying shares sank, caused some market dislocation. I think the market was down roughly 5.5% that day. But again, that's a 13D issue. It is not a 13F issue. This bill does nothing with 13D, and as Ms. Wagner already suggested, the SEC is already looking at this, and I think we should allow them to do their work on that front. But again, this bill, had it been enacted prior to the Archegos situation, would have done absolutely nothing to prevent Archegos. Archegos was 13D, this is 13F. We also go after short selling, as if short selling in and of itself is a net negative. Short selling, in many ways, can be the cop on the beat in real time. I think we look at something like the Wirecard situation, where had short sellers not been engaged in there to expose the fraud inside of Wirecard, who knows what would have happened. When we shorten the time frame, a couple things happen. One, it makes it difficult for a fund to build a short position. A short position builds over many months. You don't usually just throw it on all at once. You get into the position, and then slowly over many months, as you uncover more fraud or whatever your thesis is, you build that position out. By having more frequent disclosures, two things could happen. One, you tip off, in the event of genuine fraud, you could tip off the fraudsters ahead of time so they can cover their tracks, or do something even worse, which is what happened to Fahmy Kadir in the Wirecard situation, where she was physically attacked and harassed, and her firm was hacked, and ultimately they tried to destroy her. One of the smartest and toughest people I've spoken to in many years. And so we're going after short selling, and in doing so, you give people who might be breaking the law, who potentially are engaging in fraud, more of a heads up. You also prevent the funds from being able to build that position out over time, which is the most thoughtful way to build a position like that. And so again, I think whatever the logic behind this bill is, it seems like it's just sort of going after longstanding priorities. If it has anything to do with Robinhood and Archegos, boy, somebody's going to have to explain that to me, because based on everything I can see, Robinhood and Archegos would not have been prevented, not even a shred of it would have been prevented by this bill. And so I urge everyone to vote no on it, or at least to come up with different rationale, because the Robinhood Archegos rationale makes no sense. And with that, I yield back.
The gentleman yields back. Is there further discussion of our amendment to HR 4618? If not, the question now occurs on approving the amendment in the nature of a substitute. All those in favor say aye.
Aye.
Aye. Those opposed, no. In the opinion of the chair, the ayes have it, and the amendment in the nature of a substitute is agreed to. The question, who seeks recognition? Who seeks it? Mr. Huizinga?
Sorry, I was premature, Madam Chair.
Where is it? Was a recorded vote requested? It wasn't. Where's the wording?
Okay, no, sorry.
The question now occurs in ordering HR 4618 as amended to be reported favorably to the House. All those in favor say aye. Aye. Those opposed, no. In the opinion of the chair, the ayes have it.
Now's your time.
Now, Mr. Huizinga.
Madam Chair, I request a recorded vote.
A recorded vote has been requested. All of those in favor of a recorded vote should raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to Section C5 of Committee Rule 3, the vote on the question is postponed. Is there further discussion or amendments to the bill?
The green, down to right, down, green, Mr. Green.
Pursuant to notice, I now call up HR 4619 to amend the Securities Exchange Act of 1934 to prohibit trading ahead by market makers and for other purposes. The clerk will report the bill.
HR 4619, a bill to amend the Security Exchange Act of 1934 to prohibit trading ahead by market makers.
I ask that the bill be considered as read.
Without objection, the first reading of HR 4619 is dispensed with. The gentleman from Texas, Mr. Green, the sponsor of the bill, has an amendment in the nature of a substitute, copies of which have been distributed in advance to all members and are also on the dais. The clerk will read the amendment.
An amendment in the nature of a substitute to HR 4619, offered by Mr. Green of Texas. Strike all after the enacting clause.
Without objection, the amendment in of a substitute will be considered as read and considered base text for purposes of further amendment. I now recognize the gentleman from Texas, Mr. Green, for 5 minutes to explain the bill and his amendment.
Thank you very much, Madam Chair. And Madam Chair, I thank you for your steadfast and bold leadership as you address these systemic problems, quite frankly, with a systemic solution. This amendment protects retail investors from market makers who trade ahead of retail investors to the detriment of those retail investors. Currently, Federal Criminal Code provides that consumers who knowingly attempt to defraud a financial institution to obtain securities shall be fined not more than $1 million or imprisoned for not more than 30 years or both. These are the consequences that consumers face if they attempt to defraud a financial institution. Yet no existing federal law expressly prohibits trading ahead. Instead, prosecutors must seek to prosecute trading ahead conduct under general anti-fraud statutes, or more commonly, seek civil penalties. A new law imposing personal criminal
Will the gentleman
liability-
suspend, Mr. Green? You're not being heard. Some of our members would like you to speak louder and into the microphone so we can hear you better. The gentleman may resume.
Okay, I'll take off my, and I am speaking quite loudly on my end. Perhaps there's something in the technology that we may have to remedy, Madam Speaker, but I'll continue. And if I may, I'll start with what's happening to consumers and continue from this point. Hopefully, I'll have enough time. Currently, the Federal Criminal Code provides that consumers who knowingly attempt to defraud financial institutions to obtain securities shall be fined not more than $1 million or imprisoned not more than 30 years or both. Yet no existing federal law expressly prohibits trading ahead. Instead, prosecutors must seek to prosecute trading ahead conduct under general anti-fraud statutes, or more commonly, to seek civil penalties. A new law imposing personal criminal liability rather than civil or administrative fines is the only means to increase the degree of personal accountability for practices like trading ahead that enrich Wall Street vehemence at the expense of unwitting retail investors. This law will also remedy the status quo wherein bad actors can leverage order information for profit and still make money after deducting as merely a cost of doing business any civil or administrative fines that may be assessed. Civil fines for trading ahead have a weak deterrent effect. The penalty must be right-sized to fit the harm to the marketplace caused by trading ahead. Civil penalties don't appear to be enough, as evidenced by the fact that Citadel's disciplinary history includes fines totaling $124 million in recent years. This includes misconduct over a 3-year period when Citadel traded ahead of consumers who were forced to pay $34 million more for trades as a result of Citadel's trading ahead. Over the same period, Citadel realized revenues of $13.2 billion. Citadel and firms like it are able to build into their cost of doing business any potential exposure for comparatively modest civil fines that may be incurred. A brief overview of Citadel Securities' recent disciplinary history includes March of 2021, FINRA fined Citadel Securities $275,000 for reporting violations. July of 2020, FINRA fines Citadel Securities $700,000 for trading ahead of consumer orders in violation of FINRA Rule 5320. To assess the potential trading ahead impact, FINRA reviewed Citadel Securities' handling of consumer orders during the sample month of February 2014. The investigation found that in 559 instances, Citadel Securities traded ahead of 415 consumer orders in just a single month. According to the settlement, Citadel Securities failed to establish a supervisory system reasonably designed to achieve compliance with FINRA rules. January of 2017, Citadel Securities paid $22.6 million to settle charges that it misled consumers about the pricing of its trades. Specifically, this bill provides for forfeiture of twice the amount of all profits and compensation, including bonuses awarded upon conviction, prison sentences up to 5 years, not nearly what consumers face, and annual certifications by market maker CEOs that the ban on trading ahead has not been violated and that appropriate safeguards are in place to avoid such violations. Such certifications are similar to those required of CEOs by Congress in Sarbanes-Oxley and Dodd-Frank. Simply put, if you do the crime, you must do more than simply pay a fine. I yield back the balance of my time.
The gentleman from Michigan is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. I appreciate you recognizing me as I strike the last word, and I appreciate Mr. Green's efforts on this legislation. And I think we all can agree that bad actors, especially and particularly those who breach their duty of trust and loyalty to their customers, should and must be punished. I do have a couple of questions for the author to better understand the bill, if he'd be willing to indulge me. I'm just wondering, Mr. Green, is there a legal prohibition on trading ahead of customer orders currently?
There is, but it does not carry with it criminal penalties. It carries civil penalties. And these civil penalties are often much too weak to deter future actions. That's why this bill is necessary.
So I would put forward that FINRA Rule 5320 states, quote, "A member firm that accepts and holds an order in an equity security from its own customer or a customer of another broker-dealer without immediately executing the order is prohibited from trading that security on the same side of the market." So I think, as you acknowledge, there is clear language that outlaws this, that makes it illegal to do that. You had said earlier there is no law that is, or no legal remedy, legal prohibition in this. I mean, we know that there are people in jail for doing exactly what you have described.
Would the gentleman yield, because
the
gentleman has asked to engage me in a colloquy.
Not just yet, reclaiming my time. This is insider trading on this. What I hear you saying is that you simply want to have congressionally mandated penalties rather than SEC developed penalties. Is that true, yes or no?
If the gentleman is going to yield to me to give you a statement, I'll accept it. Otherwise, I'll ask some other member of my side to please yield to me, because I think it's only fair that you let me finish my comment. Will you allow me to finish?
I was asking a question about that.
Here's a
So
response.
apparently not reclaiming my time.
I said that the federal criminal code provides.
So what my question was is yes or no, you are wanting to just simply increase the penalties that you don't think are sufficient for this versus the SEC determining those. Is that correct?
No, is the answer.
Okay. I'm really trying to understand, I'm struggling to understand what we are trying to fix with this bill.
Well, if you will allow me to explain, I may be able to help you.
I'm happy. Happy to have you take a moment.
Okay. Currently, we do not have criminal penalties for what Citadel and companies like Citadel are doing. They have the ability to build into their cost of doing business these fines. These are civil penalties, not criminal penalties. There is no criminal law that specifically addresses these concerns. Presently, the prosecutions that take place are done with exotic means of fraud and using clever laws that they patch together. I've done my homework, and I've talked to DOJ. I've talked to FINRA as well, and I assure you that this is a criminal penalty, not the civil penalty. And by the way,
I understand that.
FINRA cannot
reclaiming
impose
my
criminal penalties.
Reclaiming my time, you took a minute of that time for that explanation. However, it's my understanding that Title 18 is the criminal law part of what you were describing, not FINRA Rule 5320. So if your intent is to complement the requirements, you did not include in the bill text all the rules, exemptions, clarifications, and guidance. And since your legislation does not mirror FINRA Rule 5320, you detail in particular behaviors happening in the marketplace right now that needs to be stopped. It's already prohibited. And what I'm hearing is you specifically want to determine what the penalties will be, not the SEC, not the regulators. You just simply believe that there isn't enough of a penalty, therefore it's upon you and through this piece of legislation that those penalties are going to be increased. I mean, you listed a number of examples of organizations that are already in trouble and paying billions of dollars in fines on this for things that have happened. So I just think that while intentioned, it's misplaced. We have a fundamental disagreement about where whether this needs to be addressed through legislation, and additionally where it should be addressed. So my time has expired, and I yield back.
The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. I move to strike the last word. Madam Chairwoman, thank you for bringing this bill up, and I want to thank my colleague and friend from Houston, Congressman Green, for bringing it forward. I would like to speak in support of this amendment, H.R. 4619, to prohibit trading ahead by market makers. And I encourage my colleagues to join me in supporting this important legislation. Trading ahead is a dangerous market manipulation tactic that pits large institutional investors against the small retail investors. When large market makers are not statutorily prohibited from these actions, there is a risk of government-sanctioned market manipulation. We must ensure that this behavior is prohibited and, as Mr. Green has explained, be held criminally responsible beyond the scope of rulemaking. We must protect consumers, and we must protect our financial markets from volatility that puts us all at risk. That is why I urge my colleagues to vote in the support of this legislation, and I yield the balance of my time, Madam Chair, to my colleague and friend, Mr. Green, if he has any other remarks he'd like to make on his bill.
I do, and I greatly appreciate the gentlelady's yielding, because my colleague, while his intentions may be honorable, his statements misrepresent what I have said. First of all, I'd like to start with Rule 5320, which does prohibit trading ahead by broker-dealers, but it includes 9 exemptions, and it applies to FINRA members. FINRA is not a governmental organization. It's a private company. It's a corporation, and FINRA has members. So FINRA is policing its members. It's time for the government to police these behemoths and make sure that they don't simply build into the cost of doing business fines that are much less than the billions my colleague has indicated is the case. They are not being fined billions. They are being fined modest fines that in no way compare to the billions they're making. They literally have the opportunity to take advantage of investors by simply building into the cost of doing business. If they don't get caught, great, it becomes a part of a bonus or some other asset. If they do get caught, they've already set aside enough money to cover their losses. So this is an opportunity to level the playing field. And for my colleague to imply that there is already a law in existence to cover this, it is absolutely not true. There is no criminal law styled a violation of trading ahead. Trading ahead is separate and apart from what we have currently, which is fraud that we use to prosecute these cases. So this would give us a criminal law specifically to deal with trading ahead, which means that a company takes advantage of investors, consumers, by trading ahead of them and putting itself in a position so that it can make the profits that might endure to the benefit of those very consumers that it seeks to represent in the marketplace. And I will yield back to the lady.
I reclaim my time, and Madam Chair, again, I thank you for bringing this forward, and I thank my colleague, Mr. Green, and I urge all of my colleagues to vote for this bill. With that, I yield back.
Thank you. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes to strike the last word.
I do move to strike the last word. Thank you, Madam Chair. And Mr. Green, thank you for bringing this issue to us. And I think you've helped clarify your intent in trying to write essentially a new criminal statute for securities-related behavior. That's at least clarifying for me, because that was unclear in trying to read through the bill. Some of the, it doesn't change some of my concerns about it, in the sense that 5320 is a rule governing all transactions in securities affected by broker dealers. And I think you're arguing that perhaps some people that might front run are not registered people. Is that right? Are you suggesting that's one of the concerns you have, is that someone who might front run an order is not registered with FINRA or a regulated entity like the SEC?
Not at all, and that's a misrepresentation. What
I'm
I'm
not trying to
saying,
misrepresent it. I'm trying to ask you a question, sir, on my
I'm not,
time.
I'm not saying you're trying to. Sometimes you do things that you don't intend to do, my dear friend, and that's what you're doing. Here's the situation. FINRA is not an arm of the government. And if you're talking
FINRA is
about
an arm of the government,
their
reclaiming my
rules,
time.
their
FINRA
rules
is
are
an
for
arm
their
of the
members.
government. It's a self-regulatory organization regulated by the SEC to enforce the SEC security laws for all of its registered people, firms, officers, and directors. So it is an arm of the government in that sense. So I'm
And
not
that's,
arguing.
well, but can FINRA impose criminal penalties? I ask you.
I think, I'm not a lawyer, I'm not going to pretend to play one here. FINRA has the ability through its adjudication process to not only put people out of business in the securities industry for violating its rules like 5320, but FINRA's counsel in each of its district offices can refer people for criminal prosecution to the Department of Justice and the SEC's enforcement.
The question again is, can FINRA prosecute criminally? And the answer is that it cannot. And the Department of Justice does prosecute, but they prosecute under fraud. Yes, this is a new law. Yes, this new law will take on the behemoths who make money by trading ahead and by building into their cost of doing business these modest fines that they pay. For example, I'll go back to the fines.
Let me reclaim my time. I'd be happy to. I know another member will yield you some time, but let me keep making a couple of points if I might. On the certification process that you outline in the bill, of course, all chief executive officers of publicly traded companies have to certify all their compliance procedures, policies, and detail under Section 404 of Sarbanes-Oxley. And if they're a registered person with the Securities and Exchange Commission or FINRA, and you would probably be both, each of the officers and directors of that company have to certify each year all the rules and compliance policies and procedures in their manual to make sure they're not breaking a rule or breaking a securities law. And each person who works for them has to annually certify that as well. So in my view, this portion of your bill seems redundant to me, and I invite your response on that.
Not at all redundant. What the bill does is require FINRA, requires companies like Citadel to have their CEOs do what Sarbanes-Oxley requires in other circumstances. And the buck has to stop with the CEO. I know that CEOs sometimes would like for the buck to stop just outside their door when it can involve them. But the way to make sure you don't have these incidents occurring is to have the CEO certified similar to the way it's done with Sarbanes-Oxley.
Okay, thank you for that. And I would argue that they do that now, both regulatorily and as public companies under current law for any criminal or compliance-related item. I think they're making that certification. When you looked at
May I ask a
criminal
question?
penalty,
As a friendly gesture, and I'll yield time to you in the future. Let me ask this question. Are you saying that currently Sarbanes-Oxley requires CEOs to certify that there has been no trading ahead?
The gentleman's time has expired. The gentleman from Colorado, Mr. Perlmutter, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. And I think just the last conversations between Mr. Green and Mr. Hill, and also between Mr. Green and Mr. Huizinga, really just clarify this for me. And that is that Mr. Green believes that we've got to have clarity as to the criminal nature of this fraud, of front running, that it is a company that's in a fiduciary position, a position of trust, that takes advantage of that position by doing transactions in advance of its clientele. And so the policy question, and it may be that Mr. Hill, you have a difference of opinion from Mr. Green, is that's criminal or not criminal in nature. And this statute, this bill proposes 5 years, up to 5 years in jail. That's really what this does. And so I'd yield back to Mr. Green to correct me if I'm wrong, and for whatever else he may want to say.
Please unmute.
Mr. Green, you got to unmute.
Thank you. You are entirely correct, Mr. Perlmutter. We do clarify, and we do, in fact, create a criminal penalty that has not been a part of the criminal statutes. This criminal penalty is a means of deterring behemoths, as I've said, these large companies, from taking advantage of persons by trading ahead. Here's an example of something that I think is important in terms of what has happened. Citadel, as a part of a disciplinary history, paid fines totaling $124 million in recent years. Citadel, over this period of time of 3 months, that included a time when it paid their customers, their traders, paid $34 million more for trades. Citadel made $13.2 billion in revenues. So let me restate that a bit clearer, please. Citadel accepts the trades. In so doing, the investors end up paying more, $34 million more for trades as a result of the way Citadel traded ahead. Citadel also, over this same period of time, when these investors were losing money, made $13.2 billion in revenues. So you can't compare this 124 million as fines to the 13.2 billion in revenues. Citadel and companies like it have to understand that there's more at stake than simply paying fines. By imposing criminal penalties that include serving time, we put them in a position such that they will control what's happening within the ranks of the departments that are beneath them. The buck has to stop someplace. This is why Sarbanes-Oxley was used to stop the buck by requiring CEOs to certify. Well, we're requiring the CEOs to certify that there is no trading ahead taking place. Sarbanes-Oxley does not currently require CEOs to certify that there is no trading ahead taking place. And this trading ahead is not as commonplace as some of the things that happen in the marketplace, but it is so common now that these behemoths are taking advantage of it to the extent that they are making profits that far exceed any fines that they are paying. And these are civil penalties, they are not criminal penalties.
Will the gentleman from Colorado yield very
Sure,
briefly?
I'll yield to my friend from Michigan.
Thank you. Look, we all agree it's wrong. We all agree that. There, as I understand how Sarbanes-Oxley works with broad attestation, this is very different what we're doing here. And maybe it's the intent of the author. And it sounds like, I'm not trying to put words in his mouth. I'm not trying to put intent on paper for him. But it sounds like he wants, and as we look into the annual CEO certification under point 2, and then on page 3, under 3, the personal liability of that for any associated person, that's very different. 5 years in jail and personal liability with the $50,000 fines or 2 times the amount of profit realized is very different from Sarbanes-Oxley. And again, maybe that's the intent. I think that's the wrong direction to go. So I yield back.
In reclaiming my time, but I think you've crystallized it. This is a policy matter, I think, for Congress to decide, and Mr. Green feels that the punishment needs to be more. And I yield back to the chair.
Gentleman yields back. Is there further discussion of our amendment to HR 4619?
I move to strike the last word. Juan Vargas.
Mr. Vargas seeks recognition. You are recognized for 5 minutes to strike the last word.
I move to strike the last word. First of all, I want to thank my friend, Congressman Green, for bringing this issue forward. I just wanted to make one point. I think the point was made incorrectly. The Financial Industry Regulatory Authority, FINRA, is not part of the federal government. It's not part of the government at all. It's a private corporation. And if someone wants to correct that, please correct that on the record, because it was stated it was part of the government. It is not. It followed a course which was before the National Association of Securities Dealers Incorporated, NASDAQ. So it's not part of the federal government. It's not part of any government that I'm aware of, and it cannot charge criminally. That's just a fact. But anyway, if someone wants to correct that, I would certainly yield time to them. But it was stated that they're part of the federal government. That's not correct. They're a private corporation. FINRA is a private corporation.
I was going to ask him, but I didn't.
I don't know if anyone wants to try to correct
Would
that.
the gentleman yield? This is Congressman Hill.
Of course I would.
Yeah. So let's not exaggerate it on any side of it. I said it is a self-regulatory organization. So it's part of the government's enforcement of the Securities and Exchange Commission regulation and statutes. It is overseen by the SEC. I'm not exaggerating that it's, you're saying it's not part of the government. Well, it's not owned by the government. That's true. But since the court settlements in the 1990s, it is no longer this sort of, completely independent organization. It is a enforcement arm of the SEC through its nature as a self-regulatory organization, where all of its decisions, all its rules, all its officers, its directors, its work, all that's approved by the SEC, the government's security regulator. So again, I don't want to exaggerate the point. I just simply want to say that it has full enforcement power, as does the commission, over all its rules and the Security and Exchange Commission rules, and it can refer people to the Federal Department of Justice for criminal prosecution, and it has the ability to levy fines, remove people from the industry, so I just think it's wrong to say, oh, it's not in any way connected to the government. Yield back to my friend. Thanks.
Thank you, and I appreciate that clarification, because I thought I had understood you to say that it is part of the government originally. And I wanted to make sure that that record was corrected. It's not part of the government, and it can enforce what it's under its purview, but it cannot charge criminally. It cannot charge criminally. I think that was the point that was being made earlier, that FINRA, being a private corporation, cannot charge criminally. Again, that was my point. I didn't want to let that point pass. Now, if I misunderstood what you said, but I think I heard it quite clearly, maybe it was a misstatement, but I believe you said it was part of the government. It is not. It's a private corporation.
Would the gentleman yield to me, please?
Of course, I'd be happy to yield to my good friend.
Thank you. I concur with what you've said and would want to remind members that this amendment is supported by Public Citizen, by the Consumer Federation of America, by North American Securities Administrators Association, and by Healthy Markets. This amendment, again, imposes criminal sanctions. FINRA deals with civil penalties, and it deals with those associated with its membership. This amendment's time has come. We cannot have circumstances where consumers can be fined up to $1 million for defrauding for securities and have prison terms of up to 30 years. But we let the corporations and their corporate leadership just walk away. Look at what happened in 2008 with all of the downturn. You didn't find very many leaders of these corporations who were responsible for this getting any penalties that were criminal in nature. So it's time for us to move in a different direction. This amendment takes us in that direction. I yield back to the chair.
Thank you for that point, and I yield back to the chair. Thank you very much.
The gentleman yields back. Is there further discussion of our amendment to HR 4619? If not, the question now occurs on approving the amendment in the nature of a substitute. All those in favor say aye. Aye.
Aye.
Those opposed, no. In the opinion of the chair, the ayes have it, and the amendment in the nature of a substitute is agreed to. The question now occurs on ordering HR 4619 as amended to be reported favorably to the House. All those in favor say aye. Aye.
Aye.
Those opposed, no. In the opinion of the chair, the ayes have it.
Madam Chair,
Yes.
I request a recorded vote on that.
Question?
Yes, Madam Chair, point of order, I request a recorded vote.
Requesting a recorded vote. A recorded vote has been requested. All of those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to Section C5 of Committee Rule 3, the vote on this question is postponed. Pursuant to notice, I now call up HR 4685, the Trading Isn't a Game Act. The clerk will report the bill.
HR 4685, a bill to require the Government Accountability Office to carry out a study on the impact of gamification, psychological nudges, and other design techniques used by online trading platforms and for other purposes.
Without objection, the first reading of HR 4685 is dispensed with. The gentleman from Illinois, Mr. Casten, the sponsor of the bill, has an amendment in the nature of a substitute, copies of which have been distributed in advance to all members and are also on the dais. The clerk will read the amendment.
An amendment in the nature of a substitute to HR 4685, offered by Mr. Casten of Illinois. Strike all after the enacting clause and insert the following. Section 1, short title. This act may be cited as the Trading Isn't a Game.
Without objection, the amendment in the nature of a substitute will be considered as read and considered base text for purposes of further amendment. I now recognize the gentleman from Illinois, Mr. Casten, for 5 minutes to explain the bill and his amendment.
Thank you, Madam Chair. My bill, the Trading Isn't a Game Act, HR 4685, which I introduced with Mr. Foster and is co-sponsored by Ms. Axne and Ms. Underwood, would direct the Government Accountability Office to conduct a robust study of the practice of gamification by online investment platforms. The rise in gamifying trading is personally and troubling, and I think concerning to all of us on this committee, and warrants congressional action. We've seen story after story of investment platforms luring investors into participating in the stock market without first making sure that those investors' best interests are served by the complexity of the products that they're being sold. Let me be very clear. This is not about access to markets. It's about investor protection, and I think we do a disservice when we confuse that point. Let's take a look specifically at Robinhood, who, as we speak, is pricing their IPO to be listed on the NASDAQ tomorrow. They are one of the top culprits of gamifying trading. Their app contained a confetti feature, which congratulated you after remaking your first trade, lottery ticket type graphics, and other features that are designed to make their site more addictive, not to create investor value. Robinhood continues to function like a virtual casino gamified to harness human psychology, where, let's be clear, the market makers are the house, and the house wins. They are designed to drive frequent, short-duration, roulette-like trades ready to extract fast money from investors against their best interest. Now, they've since removed the confetti feature, but let's be honest, they aren't E.F. Hutton. And we delude ourselves if we think that this problem is now solved just because they made this rather small change in response to public pressure. There is no existing law that prevents this type of activity, which is why it's critical for us in Congress to examine this issue, because trading is not a game. It needs to be treated with the seriousness it deserves. Individuals with very little understanding of the complexities of the investments in which they are trading shouldn't be able to engage in this risky activity. Alex Kearns of Naperville, town in my district, which is also represented by Mr. Foster and Ms. Underwood, tragically took his own life after believing that the negative balance in his Robinhood account of more than $700,000 as reported, an individual who had $7,000 to his name, a negative balance that was because he was encouraged and enabled to engage in auctions trading. He's no longer with us. My bill begins to address this rising problem by examining these practices. Now, specifically, it directs the GAO to conduct a study on the numerous impacts of gamification, psychological nudges, and other design techniques that are certainly used by companies like Facebook to drive user engagement, but are also now being used by brokers, investment advisors, or robo-advisors through their online platforms to affect the behavior of investors. The GAO can compare the activities of firms that don't have or have limited use of gamified features, test investors, and collaborate with other agencies, including the SEC Office of the Investor Advocate. This is an important issue for Congress and the regulators to engage in, and I think this bill allows us to take a good first step, informed by GAO study. They've got 270 days, which I think is a rich amount of time to do this analysis. I know that many of us on this committee do care deeply about advocating for investor protections in the interests of retail investors and ensuring that they are protected from harmful practices wherever they arise. I urge support for the Trading Isn't a Game Act. Thank you, Madam Chair, and I yield back.
The gentleman yields back. Is there further discussion of our amendment to the amendment in the nature of a substitute?
Madam Chair.
Who seeks recognition?
Adams. I have an amendment. What?
Ms. Wagner, you seek recognition?
Yes, I have an amendment at the desk.
We will pause to allow copies of the amendment to be distributed electronically.
Speak on the underlying bill? I didn't think we did.
No.
Are you sure?
No.
I feel terrible.
I didn't recognize anybody. Oh. If so, I would like to reserve a point of order on this amendment. The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to HR 4685, offered by Mrs. Wagner on behalf of Mr. Davidson of Ohio.
Without objection, the amendment will be considered as read. The gentlewoman is recognized for 5 minutes to explain the amendment, their amendment.
I thank you, Madam Chairwoman. I am offering this amendment today on behalf of Mr. Davidson. I believe it greatly improves this bill. As drafted, the bill presumes gamification is something inherently harmful. In particular, the bill text does not explicitly acknowledge that there are situations in which gamification practices could lead the customer to enter the market when the customer would not have otherwise invested at all. Simply put, the intent behind this bill is not to account for the full range of effects of gamification practices. As a result, I'm fearful the study will not produce an independent analysis surrounding gamification practices as we'd all like to see. Every broker wants their customers to spend time on an investment platform. Yet, under the bill's definition of gamification, every brokerage company with an internet application or interface could be considered to be gamifying their website. The sole purpose of this study is to push certain Democrat-led SEC initiatives and nothing less. You do not have to go far to find supporting evidence for that statement. The bill requires the GAO to evaluate, and I quote, whether and when gamification constitutes investment advice or investment recommendations under Regulation Best Interest. This is simply an attempt to attack platforms with self-directed traders as customers and expand the contours of Reg BI to include them. To quote a witness from the first GameStop hearing, Ms. Jennifer J. Schulp, I quote, innovations in trading platforms that encourage new investors to enter the market can play a powerful role in educating them just by providing them with experience. I urge my colleagues to vote yes and support this very common sense amendment that would create a balanced and neutral study rather than one that just attacks new platforms. And I yield back.
The gentlelady yields back. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. Well, first, in regards to this amendment, I think that, the role of the SEC is to protect investors. And if the conclusion is that gamification has a positive aspect, it's not important to study that in any kind of detail. It is the risks, I think, that we should be focusing on here. The Alex Kearns situation is very close to my home. The Alex actually lived in the city that I live in June of 2020. This 20-year-old resident of Naperville took his own life after he mistakenly believed that he had owed over $700,000 on an option trade through the Robinhood app. But in reality, his options trade was not fully executed, and he owed nowhere near that amount. This tragedy highlights the problems of encouraging beginner investors to use complex investing tools when they may or may not have sufficient knowledge or experience to fully understand where they put their money and what could happen to it. The complexity of investing should not be taken lightly. There's a real danger when trading platforms treat investments like a game. People using their hard-earned money to achieve in-app rewards or to chase anything besides financial returns can have serious consequences, especially when users can participate in highly leveraged positions. Everyone should learn to invest. I take great joy in visiting the practiced investing groups and teams in high schools and junior high schools in my district. But they should do so in order to build wealth and gain financial freedom and understanding of how the markets work, and not to see confetti on their investment app. Gamified trading apps exert undue influence on users to invest and to downplay the seriousness of investing your hard-earned money. And that's why I'm proud to be co-sponsoring Congressman Casten's bill to instruct the SEC to study trading gamification so that we can better understand and prevent the harms that occur when investing is turned into a game. Thank you, and yield back.
Gentleman yields back. The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. I appreciate you recognizing me for striking the last word. And I do support this amendment offered by Mrs. Wagner. Mrs. Wagner's amendment is consistent with the supposed goal of the bill, which is to examine the effects, both positive and negative, of gamification. I will note that the author talked about public pressure changing a particular app's look. I would suggest it's more like congressional pressure that actually did that. And they have, both the last speaker as well as the author have highlighted a very tragic situation that sadly is far too prevalent in society today, that kids, and I have a number of them, I have 5 of them, ages 15 up to 24, we're looking at a generation that views that as a way out, taking their own life. And that's a completely separate issue, but it is one that needs to be addressed nonetheless because it's an important issue in another venue. I would just note that many of my constituents, and I'm just betting a number of your constituents as well, are utilizing these types of apps. They are utilizing it because it's making investments accessible to them. And you know, this discussion of gamification, which we had in 2 previous hearings, this is the generation of Candy Crush, not of E.F. Hutton, for crying out loud. We don't even know who E.F. Hutton is because they was bankrupt before they were ever even born. So, of course, there is a change in how we all consume information, all consume whether it's our news, whether it's our entertainment, whether it's our investments, our banking, for crying out loud. When you go on and are able to actually do deposits and withdrawals and move things around, and I'm just curious, how many folks have apps on their phones, whether it's for PayPal or whether it's for Venmo or any other type of tool that is used. I particularly don't want all of my Venmos out to the public, but guess what? There is a generation that does. They love seeing what their friends are Venmoing back and forth and what it's for. I'm not of that generation, but I understand where they're coming from. The simple fact is the current text serves to provide cover for what I believe is new regulations on features that encourage new investors to participate in the market. And if our stated goals jointly have been in the past that we want more people involved in their investing strategies, we have to look at how that happens differently for different generations. And rather than welcome new investors to the market, this bill is only focused on pushing them out. And while the majority is trying to protect new investors by limiting their access, this amendment actually seeks to balance the study by ensuring that the study that is proposed includes a comprehensive view of the impact of gamification practices on everyday investors. Let's just be intellectually honest. Let's look at the positives as well as the negatives. And so for those reasons, I believe that as we're living in this Candy Crush world rather than an E.F. Hutton world, we need to look at and understand how different generations are dealing with the very serious issue of taking care of themselves as they invest their hard-earned money.
Will the gentleman yield?
Yes, happy to.
I'd also like to point out that we are very much in favor of a neutral study, a balanced, neutral study, just not one that attacks new platforms and specifically attempts to attack platforms with self-directed traders as customers and expands the contours of Reg BI to include them. A neutral study, as this bill started out to be, we're all in favor of that bill, but one that opens up Reg BI and some of these other platforms is not something that we support. I believe my gentleman's time is about to.
I echo that, and I urge a yes vote on this amendment and yield back.
The gentleman from Illinois, Mr. Casten, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair, and I'm going to object to this amendment about as strongly as I can. As the minority knows well, this amendment was introduced when we were debating, and the changes were so wholesale that they were simply unacceptable, and I think the spirit of this is a bit disingenuous. I have 2 teenage daughters. They do play Candy Crush. My youngest daughter is a big fan of The Sims. She has her little people going around and growing peas at night, and sometimes she loses them. I do not care. I don't think any of us on this committee care whether people lose imaginary money or imaginary peas in SimCity. I do care whether they lose their real money. That is our obligation here. The fact that you can use those same tools to encourage people to lose real money is a real problem. My goodness, we should care about that. The issues that made this change so problematic when you introduced it before committee, when we were negotiating, was the wholesale scope of these changes. As you know, we reviewed these. As you know, we went to the SEC Office of the Consumer Advocate. As you know, they were far too broad. We're looking at big picture issues. Your amendment strikes whole sections of Section 6, including references to psychological nudges, whether or not these gamifications constitute investment advice. That's a big deal. If I tell you scratch off a lottery ticket and you can buy something, I'm going to rain confetti and that makes you buy a share of Tesla, sure feels like investment advice to me. I don't know why you struck it, but it weakens the bill. Struck sections in Section 8 that would direct these companies to disclose the risks associated with these bits of encouragement. All that does is protect the Robin Hoods of the world against the investors. Struck Section 12 to require considerations of Form BD and ADV. Struck Section 9 sections around demographics. I could go on, but you know this conversation because we've already had this conversation. This is a good bill. The amendment does not. It drastically weakens this and hurts consumers, and so I strongly encourage an objection. And by the way, if there are positive impacts of gamification, the GAO has everything in their power to conclude their positive impacts as a part of their report. We do not prejudge what the outcome of the GAO's analysis is going to be, but we do prejudge that they need to look at this with an idea that we are ultimately looking after the best interests of investors. And I'd like that to be bipartisan. Thank you, and I yield back.
Is there further debate on the amendment? If not, I recognize myself for 5 minutes. I oppose this amendment. Mr. McHenry previously provided this language to Mr. Casten's office and my office. We wanted to work with them, but they gave us an ultimatum to take it or leave it. We left it. The SEC's investor advocate is a key source of information to us as lawmakers, and the amendment offered by our colleagues, however, would remove the investor advocate's role in reviewing the study and making appropriate regulatory and legislative recommendations to us and the commission. But more fundamentally, the amendment our Republican colleagues are offering would change the course of the study. These changes seem to suggest that the GAO should simply counterfeit and it should be superficial forms of gamification rather than the deep science underneath the insidious uses of gamification. Let me be clear, Mr. Casten's bill would direct the GAO, which is not partisan, as my Republican seems to suggest, to study the full breadth of the uses of behavior psychology being used by brokers and investment advisors, both positive and negative aspects of the matter, and whether such features are leading to harmful or helpful investment advice. This amendment, however, seeks to severely undermine the study before it even begins. I oppose this amendment and urge all members to reject this amendment. Is there further debate on the amendment? If not, I withdraw my point of order. The question now occurs on the amendment. All those in favor of the amendment say aye. Those opposed, no. No. In the opinion of the chair, the noes have it.
Madam Chair.
The noes have it.
Madam Chair, I'd like a recorded vote.
A recorded vote has been requested. All in favor of recorded vote shall raise their hand and be counted. There is a sufficient second and a recorded vote is so recorded pursuant to the chair's previous order. The vote on this question is postponed. Is there further discussion of or an amendment to the resolution? The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes to strike the last word.
Madam Chair, thank you for allowing me to strike the last word. I do want to voice my support for Representative Casten's legislation. The work that many online platforms have done to facilitate retail's access to trading is fundamentally a good thing. But for good reason, and many of us remain concerned by the gamification of online trading, myself included. And so as we look to take substantive legislative action, we need to have the hard facts in front of us, and that's what this bill hopes to do. So I support it, and I would recommend we pass it. Thank you, Madam Chair. I yield back.
The gentleman from Michigan, Mr. Huizing, is recognized for 5 minutes to strike the last word.
Madam Chair, I appreciate you recognizing me to strike the last word. We have different definitions of bipartisan cooperation, I guess. We've had these bills since May. We've had 2 email exchanges. We discussed a study, not a predetermined outcome white paper. It defies logic to say that there's no predetermined outcome. Just look at the name of the act. Trading Isn't a Game Act. That certainly tips a hand, shall we say, as to sort of what the expectation is. And frankly, it continues to baffle me why my colleagues on the other side want to exploit a high-profile situation like the meme trading frenzy to push a progressive agenda with these proposed, quote, solutions that will only further prevent everyday Americans from accessing our capital markets and their future earnings and deny them the opportunity to save and invest for a more prosperous future. And I love the fact that my kids have started their investing at a very early age, not with a lot of money, just a little bit, but they're learning about compound interest. They're learning about the importance of this. And if there are online tools to help that and to do that properly, I'm all for it. Now, I'm not expecting my 14-year-old, sorry, buddy, you just turned 15. I know that was last week. My 15-year-old to understand all the ramifications, which is why we put limits on that as parents. But we should be discussing legislative solutions that will open the door even wider and allow more everyday Main Street investors the opportunity to participate in our capital markets versus denying them the opportunity to pay for their own education and maybe their future children's education, and start a business, buy a house, buy a car, save for retirement. If you can get a 20-year-old thinking about saving for retirement, how in the world would this be a bad thing, folks? So it's antiquated regulations like accredited investor rules that keep Americans out of high growth investment opportunities. This outdated framework prevents investors from all walks of life from assessing certain private market investment opportunities, and we need to remove these roadblocks in the interest of fairness. And so last Congress, our Republican-led SEC worked diligently to expand the definition of an accredited investor to include people with professional knowledge, experience, certifications based on defined measures, and I applaud those efforts, but we need to go even further. Today, we should instead be discussing my bill, for example, H.R. 4708, the Accredited Investor Definition Review Act, which would require the SEC to incorporate additional certifications, designations, or credentials to further the purpose of accredited investor definitions. I think that would be helpful, and within 18 months, that ought to happen, and therefore, and thereafter assess the addition of certifications and those types of things every 5 years. We ought to look at this, folks, on a consistent basis. This bill would expand investment opportunities for sophisticated investors, not a 15-year-old, and provides private companies with additional resources of funding. I know that's not what we're talking about specifically today with this, but the point holds that we need to open our capital markets and our financial system to more people, not just those folks who are already rich and connected. And when we talk about the concern with the wealth gap, which I am concerned about, and I believe many of my colleagues on the other side are genuinely concerned about, we need to start thinking differently about how we are going to get future generations engaged in this. So in response to the GameStop situation, some of my friends across the aisle advocate for policies that would protect retail investors. If my colleagues really want to help secure the future in retail investors, I look forward to their support of my bill, 4708. But we should not be limiting opportunities for everyday investors and should be focusing on how we can make the markets work for them. And with that, Madam Chair, I would just note again, this is the generation of Candy Crush and Among Us and a number of other types of things that have influenced these kids in this generation. This is not the generation of E.F. Hutton, and we shouldn't treat them that way. So with that, I yield back.
The gentleman from Colorado, Mr. Perlmutter, is recognized for 5 minutes to strike the last word.
Thanks, Madam Chair, and let me strike the last word. First, I'd like to say to Mr. Huizenga, Madam Chair, that I'd be happy to work with him on his bill to try to, attract and make available or more accessible the markets for more people. I think all of us would agree we'd like to have our children saving and learning and becoming financially literate as soon as possible. All of us would. So appreciate the gentleman's comments on that. I'd like to yield as much time as he might need to Mr. Casten with respect to the amendment.
Thank you, Mr. Perlmutter. Like I said in my opening remarks, and I meant it, do not conflate access to markets with investor protection. It's disingenuous. It is really easy. We've known, since the first capital markets existed, everybody wants the dumbest possible money, and it is our job as legislators, it is our job as regulators to make sure that people are not, as I said to Mr. Tenev when he was sitting in this room, our job is not to feed fish to sharks. You mentioned, Mr. Huizenga, that your kids are investing at an early age, not with a lot of money, learning about compound interest. That's terrific. So are mine. They've got savings accounts and they're learning how interest works. When I talked to Alex Kern's dad, what he told me was that what I know about my kids and what I'm sure you know about your kids, they use apps that you and I are not aware of. Alex Kern said $7,000 to his name. And yet he was encouraged by this app and allowed by this app to get into an over $700,000 negative position. His parents didn't know about that.
So,
and today his parents
Mr.
don't
Casten,
have
wait a
him
second.
around.
It's my time. I just want to remind the gentleman and everybody else not to refer to him directly. Go through the chair if you're.
That's fair. Thank you. And I apologize for breaking the quorum because I don't mean this to be a personal point. It's personal to me because of the conversations I've had with this family. These young people getting drawn into this because of Candy Crush, because of these psychological nudges, we need to protect them. And if we want our kids to be protected, to not risk more money than they have, we need to make sure that these tools do not entice them to get into options trades. My goodness, if you've only got $7,000 to your name. That's the reason for this. The GAO, they will do an unbiased study, and I'm sure that they will. This is not a preordained outcome, but I do believe that trading should not be a game. It's a way to build wealth. Thank you, and I yield back to you, Mr. Perlmutter.
Yield back to the chair.
Is there further discussion? The gentleman from California
Thank
is
you.
recognized for 5 minutes, Mr. Sherman.
I rise in support of the bill. We'll often hear the glorification of the gamification of investment. I live in Los Angeles, and everybody often goes for a weekend in Las Vegas. And whoever wins comes back and brags about it. And you'd think that there was never anyone who went from Los Angeles to Las Vegas and gambled and lost. But believe it or not, somehow those casinos are showing a profit. We should be encouraging genuine investing. And keep in mind, when somebody loses their nest egg, they become eligible for a host of means-tested federal programs. When 1 out of 100 people makes a lot of money through gambling, that's fine for them, but what about the other 99? And one of the approaches, we talk in this room often about how important it is to teach financial literacy. Well, nothing undermines financial literacy more than a gamification of the process or an atmosphere in which it's thought to be a video game. That's the exact opposite of diversification, of building wealth, of saving for the future, doing all the things that we want to encourage, and that we in fact do encourage with a tax code that is more favorable to investing than it is to working, believe it or not, with a capital gains rate. So I strongly support the bill, and I yield back.
The gentleman yields back. Is there further discussion or amendments to the bill? If not, I recognize myself for 5 minutes. I rise in support of Mr. Casten's bill, H.R. 4685, the Trading Isn't a Game Act, which directs the GAO to study the gamification of investing. When we talk about gamification, we are referring to the practice of online trading platforms like Robinhood, incorporating elements of game-like features, psychological nudges, and other design elements like keeping score and providing rewards to encourage deeper engagement with and by their customers. Gamification can be harmful to investors when it turns an otherwise serious decision like investing into a thoughtless and impulsive action. But gamification done right could also empower, inform, better engage, and yes, even make investing a rewarding experience. Mr. Casten's bill, through his bill, regulators and Congress will better understand all of these uses of the gamification to better protect investors. H.R. 4685 requires the GAO to robustly study various aspects of gamification and psychological nudges employed by online trading platforms and robo-advisors that offer investment advice to retail investors. Mr. Casten's bill also wisely requires that the SEC's investor advocate review the findings of the GAO study and issue regulatory and legislative recommendations to us. This bill is strongly supported by Consumer Federation of America, North American Securities Administrators Association, Public Citizen, and CFA Institute. I urge all members to vote yes on H.R. 4685, and I yield back the balance of my time.
Madam Chair.
Who seeks recognition?
Madam Chair, parliamentary inquiry. Huizinga.
Mr. Huizinga is recognized.
Thank you, Madam Chair. I've got a parliamentary inquiry. I know we're sort of moving at some fast speed here, and I hope that the author would understand that this is a legitimate offer, legitimate discussion that I want to have, because I think we can all agree that my 15-year-old, and I'm sorry, I don't know the ages of your kids.
Will the gentleman cease? You have been recognized for 5 minutes on this legislation.
I have. My parliamentary inquiry is about an amendment that I'd like to propose. or to have a discussion and a colloquy with the gentleman about if we could.
Gentlemen, your statement constitutes debate. This is not a legitimate parliamentary inquiry. Is it?
I move to strike the last word.
The gentlewoman, Mrs. Wagner from Missouri, moves to strike the last word.
Thank you, Madam Chairwoman. I yield my time to my colleague, Mr. Huizinga of Michigan.
Thank you, I appreciate that. And Madam Chair, this is not intended to be a debate. It's not intended to continue that. I'm actually looking to see if there might be an area of actual agreement on this. If we have a common goal of making sure that 15-year-olds who cannot and really shouldn't be making financial decisions for themselves don't have access to somehow, I'm wondering if we could construct an amendment that would be satisfactory to the author that would insert some sort of buffer. In other words, if we're looking at this gamification, we've had a lot of discussion about minors, it seems, or at least the implication of that. We have people that are 21 and over that play Candy Crush and such. And I'm wondering if we could get at this in a way that the study includes some proposals, that there be some ways of exploring things like having a positive checkoff, right? If you are going in and you are going to invest, that just like if you were doing DraftKings or something else online where there is a monetary exchange, that you have to check a box that you're 18 or 21. You have to do some sort of certification that way. And it's an idea, I think, of that we're trying to get our arms around. I know this is about a study, but I'm hoping that we're also going to be studying solutions. Because, again, I think the access to this, and it doesn't matter if you are a hipster from the Bronx or if you're a kid from Zeeland, Michigan, where you're coming from, we've got to look at ways that we can expand opportunities for these folks. And so I'm not sure exactly where this fits in on this particular bill. I think that's a bit of a solution maybe, but I'm hoping that at least this study, more than just, because I am still concerned about the intent of this as it being a focus on the negative element, I hope that we're going to come up with solutions, and that part of that study is going to explore those. So with that, I'm happy to yield back to my colleague from Missouri. I appreciate that time and the ability to interject myself on that.
The time belongs to the gentlelady from Missouri.
I'll reclaim my time.
I'm happy to respond if you'll grant me the time.
I'm happy to yield my time to Mr. Casten. Thank you.
So it strikes me that my friend raises two issues. One of them, I think, is not related to age, is platforms that encourage addictive behaviors. And that's what this bill is getting. This bill is ultimately not about minors. We've talked about this because it sounds like our kids would probably enjoy spending time together. My 14 and 16-year-old, all right about the same age, if they can tear themselves off their devices. But this bill is not about a question of age. It's about encouraging addictive behaviors, and to the extent you'd like to work together as we go to the floor, as we work in Rules Committee, I'm sure that Mr. Perlmutter will make time for us to have a vigorous debate there, and I enjoy doing that. I do think you raise an interesting question, which is a whole separate set of issues, and maybe we can work on a bill around this, which is the question of how do these platforms ensure that the people who are using them are who they say they are? We don't touch any of that in this bill, and frankly, I haven't heard anybody who's talked about that. But I will tell you that in the course of speaking with people in preparation for the GameStop hearings, I heard stories about people whose teenage kids were able to go on Robinhood, were able to use a parent's email to validate themselves not only as someone who was old enough to engage in these platforms, but actually had the financial sophistication to trade options. There's a real problem there. Not at all covered by the scope of this bill. I do think it touches on some of the minors, and so yes, I'm happy to work for you as we go to the floor. But I think there's a separate question there. This is really just about encouraging addictive behaviors and making sure that those are being protected. And I thank the lady for the
I appreciate that, Madam Chairman. Our Chairman, I yield back.
The gentlelady yields back. If there are no further amendments, without objection, the previous question is ordered on HR 4685 and pursuant to Section C5 of Committee Rule 3, further proceedings on the pending amendment are postponed. Pursuant to notice, I now call up HR 4620, the Family Office Regulation Act of 2021. The clerk will report the bill.
HR 4620, a bill to amend the Investment Advisors Act of 1940 to limit the exemption provided for family offices from the definition of an investment advisor and for other purposes. Be it enacted by
Madam Chair, I request that the bill be considered as read.
Without objection, the first reading of HR 4620 is dispensed with. The gentlewoman from New York, Ms. Ocasio-Cortez, the sponsor of the bill, has an amendment in the nature of a substitute, copies of which have been distributed in advance to all members and are also on the dais. The clerk will read the amendment.
amendment in the nature of a substitute to HR 4620 offered by Ms. Ocasio-Cortez of New York. Strike all after the enacting clause and insert the following.
Without objection, the amendment in the nature of a substitute will be considered as read and considered base text for purposes of further amendment. I now recognize the gentlewoman from New York, Ms. Ocasio-Cortez, for 5 minutes to explain the bill and her amendment.
Thank you, Chairwoman Waters, for holding this important markup and for considering my bill, the Family Office Regulation Act of 2021. Through a loophole in current law, all investment funds organized and registered as quote-unquote family offices are exempt from registration with the SEC and have no requirement whatsoever to disclose their size, portfolio, or leverage. Now, due in part to legislative and regulatory exemptions, unsurprisingly, this loophole has created a massive rush of funneled cash into these entities deemed as family offices. So much so that a 2021 report by Ernst & Young estimated that the amount of money held by private family capital now outstrips all private equity and venture capital combined, with at least 10,000 single-family offices in the world. I'm proud to offer this bill, which is long overdue. Specifically, my bill would limit the use of family office exemption from registration as an investment advisor with the SEC to offices with $750 million or less in assets under management. So if you are a family office that holds less than $750 million in assets, you can retain that exemption. But family offices, funds organized as family offices with more than $750 million in assets under management would have to register with the SEC. The bill would also repeal a grandfathering clause in Section 409 of Dodd-Frank that permitted family offices that have clients that include persons who are not members of the family to not register. Finally, the bill would authorize the SEC to require by rule the registration of family offices that are below the 750 million threshold if they are highly leveraged or engaged in high risk activities. Family offices have now grown to the point that they are deeply interconnected with the rest of the financial system, and their activities could affect the stability of our financial markets. There are plenty of examples, including the Auchincloss implosion earlier this year that led to $10 billion in losses. But the Auchincloss implosion is not the only reason why we need this bill. Consider this. One, family offices now manage more capital than private equity firms. As I mentioned, the more than 10,000 family entities registered as family offices in the US manage a combined $6 trillion in assets. This is more than all US private equity firms combined, which now hold, as of 2019, only $4.1 trillion in assets. The second is that tech titans and the ultra-rich use family offices to exacerbate inequality and leverage tax advantages. Reporting by ProPublica earlier this year found that the 25 richest Americans pay little to no taxes thanks to the preferential treatment of their investments in the tax code, and many of them are using the advantages and and lack of transparency in family offices to evade and not pay their fair share in taxes. Third, family offices are now starting to move into volatile cryptocurrency markets. Family offices are also emerging as significant investors in cryptocurrency hedge funds. Assets under management in these cryptocurrency funds reached $36.9 billion in July of this month, while a 2020 report by PwC found that nearly half of all such investors in these in crypto private funds are in family offices. I would also like to enter the fact sheet into. I would also like to enter into the record a fact sheet authored by Open Markets Institute regarding the risks family offices pose to the financial system, as well as a statement of support from Americans for Financial Reform.
Without objection, such is the order.
In sum, I think that this is a rather common sense provision. If we want to prevent systemic risks, I believe it is eminently reasonable that a family office that holds almost $1 billion in assets simply register with the SEC. And if you have less than $750 million in assets, but you are extremely highly leveraged or engaged in very high-risk activities, I think the bare minimum is to ask for and require registration with the SEC. Normal family offices that have less than $750 million in assets can preserve their exemptions. But again, I believe it's eminently reasonable to expect a family office that holds almost $1 billion in assets to register. Thank you.
Madam Chairwoman.
Madam Chair.
The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes to strike the last word.
I thank you, Madam Chairwoman, and I do move to strike the last word. This bill is a pretty significant rollback of the SEC's family office rule. So I have a couple questions for the gentlewoman from New York, Ms. Ocasio-Cortez. Ms. Ocasio-Cortez, the Dodd-Frank Act included a provision requiring the SEC to define family offices in order to exempt them from regulation under the Investment Advisors Act. The purpose of the SEC's family office rule is to allow a family office to give investment advice to a family client without registering under the Advisors Act. This exclusion makes sense because it recognizes that families should be able to manage their own finances without government interference. This bill upends the policy justifications by requiring family offices with over $750 million in assets under management to register with the SEC, and in addition to requiring some family offices with less assets under management to in fact register. I have a couple of questions for the gentlelady from New York, Ms. Ocasio-Cortez, if she would so engage. Why is it appropriate now for the SEC to interfere in the financial matters of individual families?
If I may?
Mm-hmm.
I think one of the things that the SEC did not, that where there was an oversight in the passage of Dodd-Frank is that I don't believe that we saw, and perhaps that individuals saw, the acceleration of income inequality to the extent and the degree that it exists today. And so the idea that a single person or a single family could hold enough wealth that they could represent systemic risks was something that could not be really factored in back at that time. But now we have the ascent, particularly even during the pandemic, of not just billionaires, but super billionaires whose own holding could represent a significant threat to any one individual or market, which is why we believe that any one office, I believe in the underlying concerns of the bill, which is why we preserve those.
Reclaiming my time, because I have several questions. Are you concerned by the privacy implications that this bill raises with respect to families managing their own money? And did I understand you to say that this was a bill about income inequality and not about an overturning of the SEC's family office rule and an invasion of privacy, allowing families to make their own investment decisions?
Well, it's certainly not about income inequality because it's about assets rather than what salary an individual is being paid. But I believe that what we really need, this is really about systemic risks. If Jeff Bezos has $1 billion in assets and is trying to trade in a highly leveraged way,
Well, let's
which
talk about that.
threatens
Reclaim my
small
time.
families, then he should register with SEC.
Reclaim my time. How did you choose a $750 million threshold? Was it about family offices with over what is it about family offices with over $750 million in assets under management that justifies a rolling back of the family office rule and requiring SEC oversight of those family offices compared to a family office with $745 million in assets under management?
Well, I'm sure the congressman is no stranger to the fact that at the end of the day, many times we have to draw a line somewhere. And I believe that there's eminent consensus around this figure. A family office can hold $500
Consensus from whom?
In assets. Pardon?
Consensus from whom?
Well, among our colleagues.
Certainly not on.
And regulators as well as.
Certainly not with the SEC, or certainly not Ms. Ocasio-Cortez. The Investment Advisors Act of 1940 is focused on investor protection. It does so through disclosing and minimizing conflicts of interest between clients and people they pay to manage their money. Family offices were exempt from registering under the Advisors Act precisely because it was believed that family offices can and should manage family money with fewer conflicts of interest. I'm wondering how that premise has changed, and what about family offices leads you to believe that they should now be covered by the Advisors Act?
Well, in 1940, we had much higher rates and, we had a fairer economy. It wasn't all the way fair, but it was much fairer.
A fairer economy? I yield.
The gentlelady's time has expired. The gentleman from Texas, Mr. Green, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair, and I thank Ms. Ocasio-Cortez for this piece of legislation. She has indicated something that bears.
Mr. Green, would you speak up, please, so that
Yes.
Mr. Perlmutter can hear you?
Thank you. I am speaking rather loudly. I think there may be some technology problem, but I support Ms. Ocasio-Cortez and what she's trying to do. And she said some things that, in my opinion, bear repeating. 10,000 of these family offices across the nation, the world, in fact, $6 trillion in assets. This is major money, and this is a circumstance that should call to our attention some concern. Archegos is the proverbial canary in the coal mine, as I see it. I was here, and I remember long-term capital. Long-term capital had investors, the principal investors, who were Nobel Prize-winning economists. But it was opaque, and it was that opacity that created the problems. They had derivatives that could not be explored by the SEC, or if so, to a limited extent. They were requiring their investors to invest for some period of time and really give no information to them about what they were investing in. Long-term capital was the the canary in the coal mine at the time. And when long-term capital started to fail, we saw AIG attempt to prop it up. My point is, we see now another opportunity to prevent a circumstance that developed after long-term capital. With this $6 trillion, and some of it going into cryptocurrency, going into the broader economy, we're not talking about a home office where you have a person who sits there behind a desk and he's taking care of the business of a family. Well, this family business now is integrating itself into the broader economy. And as it integrates itself into the broader economy, it can pose systemic risk that we did not contemplate at the time we were initially embracing concerns related to family businesses. So I absolutely support what Ms. Ocasio-Cortez is attempting to do in terms of giving a carve out for $750 million. I think that's more than reasonable. And I support the notion that we have to have more insight into what's happening within these family offices. And I will yield the balance of my time to Ms. Ocasio-Cortez.
Mr. Green, could you yield to me?
I'm going to yield to the gentle lady. I believe you'll be able to claim time. Let me yield to the gentlelady, Ms. Ocasio-Cortez.
Mr. Green yields to Ms. Ocasio-Cortez.
Thank you, and I thank the congressman for his support of the bill. And again, this is really about, at the end of the day, systemic risks. And when there's concentrations of wealth, and then when there are shadowy entities that are allowed to escape all oversight, no matter their size, no matter how much risk that they're taking on, that presents a systemic risk to our financial system. And ultimately, this is a pretty basic requirement. It's simply registration with the SEC if you have nearly $1 billion in assets, or if you are engaged in extremely high risk financial activity. And really, that's what ultimately this is about. This is about preventing systemic risk because of the emergence and the use and abuse of the registration of family offices to hold and engage in activities with enormous sums of wealth that absolutely pose systemic risks without basic oversight and registration with the SEC. Thank you.
The time belongs to Mr. Green.
Will the gentleman from Texas yield?
I shall. I yield to the gentleman from New York. California, excuse me.
That would be the very good-looking gentleman from California. Thank you. Just a couple of points. These family offices, you would think it's just a husband and wife. Yeah, they can involve well over a dozen family units pooling their power, investing as a group. Some are more active than others. Some may even need protection from the investment advice that they're getting. I support the bill. I look forward to working with the author and the chair of the full committee in making sure that the SEC has the authority by regulation to change the registration form that would be applicable, since the Investment Advisors Act registration form may not be fully applicable to family office. I yield back.
The gentleman's time has expired. The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate the recognition. And I also have a few questions about my colleague's bill. And through you, Madam Chair, I'm hoping that Representative Ocasio-Cortez would be able to answer a few of these. The author's bill sets the exemption threshold for family officers to register at the SEC at 750 in assets under management. That was brought up by my colleague from Missouri. I guess she believes that there is consensus that that's the right number, but I don't see anything in the bill that contemplates fluctuations of value, market value. The market goes up, market goes down, inflationary pressures that may happen. And while I have no realistic belief that my family is ever going to have these kinds of assets, there are some that have and have earned that over whether it's one generation or multiple generations. But I don't see anything in your bill that contemplates those fluctuations and what happens for a family office that's at 740 and doesn't have to register. The market goes up for a couple of weeks, it becomes a $760 million value. Does it then have to register? How quickly does it have to register? And what happens when it falls back down to 740 million and it's below the threshold?
If I may.
Please.
Thank you. I think these are all excellent questions, and this is one of the reasons why we don't want to be overly prescriptive within the language of the bill. So what this does is that this yields some of that discretion to the administration within the SEC, in which the SEC can then make these determinations and what they see fit in what is healthiest and best for preserving stability in our financial
So
system.
you're anticipating that the SEC would come up with some sort of rule that would then dictate how that would be handled?
I believe that the rules determined by the SEC would do a better job than us being overly prescriptive in the provisions of the law, yes.
Your bill also bars people who are subject to the final order described in Section 15B4H of the Exchange Act from being able to take advantage of the family office exclusion. 15B4 outlines basically bad actors and different
nefarious actions that have been taken. But I believe that H applies to people subject to state security barrings and other punishments. Why did you pick those particular bad actors versus the others that are outlined in 15B4 more broadly? I'm afraid I'm missing something here.
Mhm. Well, one of the things that I think we see in particularly what we've noticed in the developments with Auchincloss as well as other abuses is that these, I believe, are provisions that are particularly leaned in creating that systemic risk.
But is there anything particularly relevant about the state securities laws here? That's what the H part of 15B4 outlines. So maybe you can get back to me on that.
We can definitely get back to you.
And with all due respect, I have to take issue with your statement of in 1940 we had a fairer economy. Simply wasn't the case. Simply wasn't the case. There were not more people who were wealthy. There were more people who were poor. My family was one of them on both sides. And maybe that's your goal, to have fewer wealthy people and overall poorer nation. That's certainly not mine. And through the chair, I will accept my admonition.
The gentleman is recognized for a point of order.
That's fair.
Mr. Huizinga.
Yes. Thank you, and that is proper. I just needed to add some historical perspective on that. I will note in my remaining time here, the family office that is there, and again, my family will never be there, and I don't know if anybody else is in this room ever will be. But there is no conflict when you are investing your own money. Now, when that family office then uses outside investors and advisors, that's when all those protections apply. I mean, you can't steal from yourself. You can't steal from your own family. Now, you can have your assets stolen or mismanaged by others that you then have a contract with. But it seems to me we're trying to go at the wrong target here with the family offices. And with that, I yield back.
The gentleman's time has expired. The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair, and thank you for bringing this bill forward and put it on the agenda. And I want to thank my colleague and friend, Mr. Ocasio-Cortez, for moving forward on this bill. Family offices have flown under the radar, avoiding adequate oversight for just far too long. As the author has stated, these offices do not have to register with the Security and Exchange Commission, file public reports on their positions, or report to the regulators about their leverage. Yet these firms manage billions and billions of dollars, often overseeing the fortunes of the nation's largest billionaires, whose very decisions have an outsized impact on our economy. This leaves us with a significant source of vulnerability in our financial system, and one that we must address. I agree with the author. If we cannot measure or account for leverage firms managing billions of dollars, how can we oversee systematic risk? This issue is not going away. This risk is only becoming more prevalent. A recent survey found that an increasing number of family offices are investing in cryptocurrencies, creating a growing share of shadow finance that cannot be tracked. And 22% of these family offices surveyed managed over $5 billion. The lack of visibility into this industry is very, very concerning. We must take the first step in requesting transparency. I thank Mr. Ocasio-Cortez for bringing this forward, and I urge my colleagues to join me in supporting transparency and mitigating risk by supporting this bill. With that, I yield the remainder of my time to Ms. Cortez, if she should need it.
Of course, and wait, can I yield to our next speaker, or do I yield that back to you as a question parliament?
If you have something to add, you do it, and if not, you yield back to me,
Okay,
then I yield to whoever it is.
Right. I'll yield back to the Congresswoman from Texas. Thank you.
All right, and who needs time?
I believe Mr. Perlmutter was.
Mr. Perlmutter, do you
So are you, Ms. Garcia, are you yielding time to Mr. Perlmutter?
Yes.
Mr. Perlmutter?
Sure, thank you. I thank the gentlewoman for yielding time. Madam Chair, Ms. Wagner asked a couple of questions. Why do something now about Dodd-Frank? And having been present for the negotiations around Dodd-Frank and the exemption or the language exempting family offices, I think in part, well, it was they can take care of themselves. Then I particularly became concerned, and I'm not exactly sure how to say it, Archegos or Archegos or however you say it, Archegos, when there was the collapse of Archegos and the leverage that it had exhibited affected a number of other institutions, I became particularly concerned about these family exemptions, these family business exemptions. And so I appreciate the gentlelady from New York taking this matter on. And Ms. Wagner asked fair questions. Why 750 million, not $1 billion? Why? Those are fair questions. But I think from my point of view, the fact that there has to be some better understanding, some more transparency for these organizations, and the sizes will be something that the SEC or others can discuss, I think really is appropriate. And having been around for those initial discussions. So that is all I was interested in saying, and I yield back to Ms. Garcia.
I yield the remainder of my time now to the vice chair of our committee.
Thank you. I'm in support of this. I think it's as the gentlelady from New York said, a common sense update to reflect the new scale and sophistication of these investment managers that was not envisioned when the bill was written. I want to speak specifically to a little bit of the back and forth at the beginning about 750 million as the number. Is there a radical difference between 749 and 751? Of course not. But one, we need a starting point. Whenever you're trying to regulate a new sector, you got to figure out, put a line in the sand. And it's very reasonable to do it here. It has the virtue of being simple so that it's easily enforceable and understandable to industry. And it's also adjustable, of course. The SEC and Congress can examine the outcomes and decide if we have to move it left or right. So 750 is not armor plated. It's just simply a starting point for us, and it's an appropriate one. And I yield back.
2 seconds left. 3, 4. Mr. Ocasio-Cortez, you won the last second. Madam Chair, I yield back the remainder of my 10 seconds.
The gentlewoman's time has expired. The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes to strike the last word.
Thank you so much, Madam Chair. I move to strike the last word. Thank you with my good colleague for introducing this bill. We know that our tax code is already rigged to favor the richest Americans. And if I may, Madam Chair, would like to submit for the record article by the Institute for Policy Studies titled Family Offices, $1 Trillion Pools of Unregulated Capital You Haven't Heard About, where they discuss how billionaires pay millions to hide trillions of dollars of assets. And we know over the past decade, Madam Chair and my good colleagues, that it's only gotten easier for the wealthy to hide their investments and avoid paying taxes on their holdings. As billionaires park their wealth into these so-called family offices, they do so without registering with the SEC, filing public reports on their positions, or reporting to regulators about how much leverage they employ. And unsurprisingly, America's billionaires have been exploiting this Dodd-Frank exemption to the point where family offices now manage nearly $2 trillion more than America's private equity firms. We need to wake up and see that they are abusing this exemption to hide the assets. And this loophole is out of control. And so I applaud my colleague from New York for introducing this much needed reform in HR 4620. And I thank the Madam Chair for yielding, and I yield back.
The gentlelady yields back. Is there further discussion of or amendments on 4620, HR 4620? If not, I recognize myself for 5 minutes. While the term family office may suggest that they are fairly small investment funds, in reality, the vast majority of them are very large investment funds that pool together and manage the money of wealthy families. By some estimates, family offices collectively control over $6 trillion in assets, which is larger than venture capital and private equity funds combined. And the average fund is approximately $1 billion. Family offices tend to focus on investing in private equity and hedge funds, and reportedly control huge chunks of farming lands and real estate assets. But hard data on family offices is not available because currently family offices are not required to register with the SEC, allowing them to operate in the dark. Neither the SEC nor other regulators know who these entities are, where they operate from, the assets they control, or other basic information. While most family offices cater to the financial needs and goals of financially sophisticated individuals and do so secretly, there are others that are operated by individuals who appear to solicit investments from non-family members, and in some cases are even run by people who have been barred from the industry. One such firm is Auchincloss, whose founder pleaded guilty to insider trading in 2012 and was barred from the industry. Yet he created a family office, took excessive and undisclosed risk, and ultimately caused over $10 billion in losses to banks. Lack of family office registration was justified years ago on the grounds that they are sophisticated financial players who know what they're doing, and therefore the risks they take won't negatively impact others. But the recent incident with Auchincloss should cause us all to question these underlying assumptions. Representative Ocasio-Cortez's bill would bring much needed transparency into this estimated $6 trillion industry. It will allow the SEC to create tailored reporting regimes for family offices. These reforms are supported by Americans for Financial Reform, Consumer Federation of America, Open Markets Institute, and many other experts. So I would urge my colleagues to support Ms. Ocasio-Cortez's bill, and I yield back. The gentleman from California, Mr. Vargas, is recognized for 5 minutes to strike the last word.
I move to strike the last word. Thank you very much, Madam Chair. And I want to thank my colleague from New York for bringing this important bill forward. I was going to say a number of the things that now have been said and were said earlier. The Archegos collapse. We take a look at what happened there. It was interesting because I think many of us started having flashbacks about margin calls and complex derivatives. And I think we were trying to figure out, well, there's so much money in these family offices that potentially this really could be a systemic problem for us. And I think it's very important for us to have more transparency here. That's one of the things about family offices. They do not have to file the quarterly 13F filings. We really don't know what they're dealing with. I've had a lot of issues myself, as many have, with the cyber currencies. We know that they're used for very nefarious things. They can use for very positive things too, but also for nefarious things. And so just because of their scale now, I think they do pose a potential systemic risk to our economy. And I think that we do need to have more transparency. I thought that's why this bill was very well written, intended. Now, we could argue about exactly where that level should be. Is it 750 million? Is it 500 million? Is it $1 billion? I don't know. There 750 million was chosen. I think it's a good number because most of these family offices are $1 billion or more. So it would capture, I think, those that do present systemic risk. But again, I think it's a very good bill. I'm glad it was brought forward. I think Archegos opened our eyes to a potential huge systemic risk here that we're really not aware of, or we weren't aware of until they collapsed. So again, I thank the author for bringing this forward, and I thank the Madam Chair for allowing me to speak. That I yield back.
The gentleman yields back.
Madam Chair.
The gentlewoman from New York, Ms. Velasquez, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chair. I move to strike the last word. I agree with the chair and my other colleagues. These funds are not just managing their own money. And a loophole in our securities law have allowed them to evade regulation. I also agree with Mr. Perlmutter and Mr. Green that the recent Archegos failure has highlighted this important issue. So I support my colleague from New York, Alexandria Ocasio-Cortez, from bringing this important bill forward. And I urge its adoption, and I yield back.
The woman yields back. Is there further discussion of or amendment to HR 4620? If not, the question now occurs on approving the amendment in the nature of a substitute. All those in favor say aye. Aye. Those opposed, no. In the opinion of the chair, the ayes have it, and the amendment in the nature of a substitute is agreed to. The question now occurs on ordering 4620 as amended to be reported favorably to the House. All those in favor say aye. Aye. Those opposed, no. In the opinion of the chair, the ayes have it.
Madam Chair,
Yes,
I request a recorded vote.
gentleman requests a recorded vote. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to section C3 of Committee Rule, C5 of Committee Rule 3, the vote on this question is postponed. Get it up from there.
Pursuant to notice, I now call up HR 3555, the Voters on the Move Registration Act. The clerk, will report the bill.
HR 3555, a bill to require the inclusion.
Without objection, the first reading of HR 3555 is dispensed with. The gentlewoman from Georgia, Ms. Williams, the sponsor of the bill, has an amendment in the nature of a substitute, copies of which have been distributed in advance to all members and are also on the dais. The clerk will read the amendment.
Amendment in the nature of a substitute to HR 3555.
Without objection, the amendment in the nature of a substitute will be considered as read and considered base text for purposes of further amendment. I now recognize the gentlewoman from Georgia, Ms. Williams, for 5 minutes to explain the bill and her amendment.
Thank you, Mr. Vice Chair. The Voters on the Move Registration Act is based on a simple idea. All people should have the tools that they need to exercise their voice in a representative government. Helping people register to vote as they prepare to move into their new homes is one of the simplest ways to strengthen our democracy, and that's exactly what this legislation does. Most of us have moved residences before. Moving is a time where we think about things like juggling boxes and getting furniture through the door, but not necessarily about voting. But if we don't include voter registration as a part of our move, barriers may stand in the way of voting at election time. This is especially true for people without stable housing, who are regularly on the move and have so much more work to do to keep their voter registration up to date. Folks working multiple jobs who lack time and resources to research how to register or re-register to vote, and individuals who need reliable information about how to get registered because their elected officials continue to change the laws, and that varies from jurisdiction to each state. I authored this legislation with the same goal as everything that I do in Congress, to uplift those most marginalized. And all of us, especially those most marginalized, could use a reminder and more information about how to register to vote when we move. My bill will task the Consumer Financial Protection Bureau, in consultation with the Election Assistance Commission, with developing a statement including information on how individuals can register to vote and their voting rights under the law. This statement will be provided to tenants in public housing, tenants in HUD-assisted housing, and tenants in properties with federally backed single and family multifamily mortgages. It'll also be provided to applicants for residential mortgage loans. This common sense legislation will empower people with the information they need to participate in our government, no matter their zip code or the zip code that they're moving to. I urge all members to support this legislation, and Mr. Chair, I yield back the balance of my time.
The gentlelady yields. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes to strike the last word.
I thank the chair for the time, and I appreciate the opportunity to speak in opposition to this bill, but not to the concept of finding ways to get information to all of our citizens in all of our states to make sure they have an opportunity to be registered to vote and cast their vote and have that opportunity to participate in our amazing American democracy. But Mr. Chairman, H.R. 3555, in my view, is a sort of textbook definition of regulatory overreach. It's another unwise and unnecessary expansion of the CFPB's unending hunger for power. The CFPB has no expertise or statutory authority in election law, voter registration, or voter rights whatsoever. They have no background to develop a required uniform voting statement. First, and the first principle for all of us, and we all know this quite importantly, that Article 1, Section 4 of the Constitution vests the states with the responsibility to conduct elections. The Federal Election Assistance Commission, the EAC, is tasked to be, and I quote, the National Clearinghouse of Information on Elections and maintain the National Voter Registration Form developed in accordance with the National Voter Registration Act of 1993. These are facts that the sponsor of H.R. 3555 now openly concedes. And that's why this new draft presented to us today for the bill includes new provisions that were not in the original text as originally offered by Ms. Axne's bill that would require the CFPB to obtain from the Election Assistance Commission the content regarding voter rights and registration issues needed in order to develop this uniform statement. In other words, the bill would require the CFPB, which describes its purpose to protect consumers from unfair, deceptive, and abusive practices, to essentially plagiarize the EAC's work for no other reason than to create legal jeopardy, gotcha type legal jeopardy for mortgage lenders and private landlords. H.R. 3555 has nothing to do with voting rights and everything to do with weaponizing election notifications as a tool for the trial bar to exploit the law in a new and ever creative way. Further, Mr. Chairman, this bill would simply add more red tape and complicate the process of closing on a home, receiving federal rental subsidies, or even simply renting an apartment in a multifamily building while providing no meaningful information to recipients. Elections are inherently local, with local voting rules, timelines, formats, and eligibility varying greatly from locality to locality and from state to state, as we've certainly learned over the past few months. This data cannot be distilled down into a simple, quick, easy, meaningful, uniform statement imposed by the CFPB. Adding more complexity and additional opportunities for liability, the bill also requires the uniform statement to be translated into the 10 most commonly spoken non-English languages. So in summary, in my view, this bill is unnecessary. It's part of an overarching strategy to continue to try to federalize the elections and not focus on the states' rights as outlined in the Constitution for the time, manner, and place of elections. Moreover, it continues to, again, a priority for the majority to empower one of the most unaccountable agencies in government, the CFPB. I urge my colleagues to consider these items and to oppose this proposal, and I yield back the balance of my time.
The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Chair, and I'd like to speak and strike the last word on this bill. I'm in support of this amendment in nature of substitute for HR 3555. I encourage my colleagues to join me in supporting this important and necessary legislation that accomplishes a simple task. It gives residents a clear and coherent snapshot of their voter registration information, simply passing information. We're not asking anyone to be an election official. We're not asking anyone to administer elections. We're not asking anyone to, other than just simply hand over information. So to be clear, let's remember the right to vote is the foundation of any democracy and must be protected, and voting should be encouraged. Voter registration is location dependent. Voters whose location changes deserve to have information on how their voter registration may be affected and how to make changes to comply with voter registration laws. This need is even greater for Americans with limited English proficiency, whose right to vote has been targeted in recent years. I can attest that at every election in my district, which is 77% Latino, we get numbers and numbers of calls of people needing information, of people being denied any language assistance at the polls, of people not finding information in their own language. This must stop. Not all of the families in my district are proficient in English. They are tax-paying Americans who deserve full access to their voter registration information. This bill ensures that voter registration information is provided in the top 10 languages most commonly spoken by those with limited English proficiency. Again, the information would be printed in those languages. Obviously, my district probably wouldn't ask for, let's say, French, if that's one of the top 10, because I doubt there's any people in my district that would need French language information, but they would certainly need it in Spanish. This information is vital to preserving full participation in our democracy. One's right to vote must be fully communicated with them, and when that right to vote is subject to change when one relocates, it is our duty as a governing body to ensure that residents have full information surrounding that right. I look forward to working with the author on this very important piece of legislation, and I urge my colleagues to do the same. With that, I yield to the author if she has any other comments that she would like to make with the remainder of my time.
Thank you. I would just like to address one of the concerns that Mr. Hill had, Mr. Chairman. The Consumer Financial Protection Bureau and the Election Assistance Commission were consulted in writing this legislation, and they raised no concerns about issuing a uniform statement, because it's just that, a uniform statement. Other committees have had a chance to review my substantially similar amendment to HR 1 when it was authored, made in order, and passed the House. And this bill has received extensive overall vetting. We've also gotten technical assistance from the Consumer Financial Protection Bureau and the Election Assistance Commission. So this bill effectively utilizes the respective areas of expertise for both the Consumer Financial Protection Bureau and the Election Assistance Commission, and neither entity has to go outside of its specialty to meet the requirements of the bill. Under the bill, the CFPB is responsible for developing the format of the statement, doing consumer research and testing of the statement, and obtaining from the EAC the content regarding voter rights and registration issues needed to create the statement. And so they're only responsible for making the statement itself user-friendly, but it gets the content from the expert areas. And I yield back the balance of the time.
Well, thank you. And with that, again, let me just say that I very strongly support this legislation. It certainly is something that is needed. This is not a gotcha plan, and it is not a plan for lawyers to litigate. I mean, as a lawyer and a judge, I can tell you, I see nothing in here that would encourage that. What it would encourage is for people to vote, to change their registration forms to reflect their new addresses. This is a critical bill, and I intend to work with the author to make sure that it has full passage. With that, I yield back the remaining 16 seconds of my time.
The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Chairman. I do strike the last word, move to strike the last word. I'd like to associate myself with the gentleman from Arkansas's remarks a moment ago with regards to, I think it's important that we help people be able to participate in our democracy, be able to make it as easy as and as protected as possible. But I also want to associate myself with his remarks of concern with regards to this. Everyone in this room understands that my colleagues across the aisle want to drastically expand the power of the CFPB. Over the past 2 years, the majority has introduced legislation to create a public credit bureau at the CFPB, to expand CFPB authority over business lending, and to give even more authority to regulate and burden the numerous industries they oversee. When I look back on these efforts in shock, or say, while I look back on these efforts in shock, none of those previous attempts were so blatant and lacked as much precedent and authority as the legislation before us today. This legislation would give the CFPB the authority to create a uniform statement outlining how an individual can register to vote. It would then require public housing agencies, PHAs, to owners of federally assisted properties or lenders of a federally backed mortgage, which is almost all of them, to provide that information to consumers when they apply for a mortgage. I'll say it again, the Consumer Financial Protection Bureau is going to create voter registration information and force landlords and lenders to provide it to tenants and borrowers. This legislation really astounds me. Nowhere in Dodd-Frank, where the CFPB was given its significant authority over consumer finance, was any authority over election law granted. None, zero, nada. The CFPB has no election law experts, no previous experience with election law, and certainly no knowledge of local voter registration processes. Furthermore, voter registration laws widely vary throughout the country, including registration timelines, formats, and rules. Even if it were in the CFPB's jurisdiction, it would be impossible to create a uniform statement on how a consumer can vote. Does my colleague from Georgia know that this statement would look what it would look like? Honestly, how would you put together a uniform statement with all of the myriad of voting precincts around this country, voting local rules, local state legislative rules and processes in place? Impossible, impossible. But that's my point. Because the uniform statement cannot cover every voting jurisdiction in this country, it's the goal to give the CFPB more authority to dictate voting registration. It's a power grab. Until today, almost all of us would think that that question would be ridiculous. Yet here we are. They want the government to decide who qualifies for a loan. They want the post office to handle money. And now they want CFPB to determine voting registration processes across the country. Unbelievable. If this were a serious effort, it'd be funny. And while this bill is certainly laughable, it's a very disturbing depiction of the power the majority wants the federal government, in particular CFPB, to hold. The author of the bill indicated earlier that she got the blessing from the CFPB to put this bill together. Why would they object to this? It's more power, more authority, with almost no oversight. It's a win-win-win for them. They'll be blessed with your bill and would love every minute of it. With that, I urge my colleagues to oppose this bill and I yield back.
The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Vice Chair, and I do move to strike the last word. I do want to thank my colleague, Representative Williams, for introducing the legislation. It definitely is needed. The most fundamental right in our democracy is the right to vote. And while we've made amazing strides over the past century, votes for women, voting rights for Native Americans and indigenous peoples, the end of racist Jim Crow laws that almost completely suppressed the Black vote in certain states, and lowering the voting age to 18, we are still marching because the promise of one person, one vote continues to be abridged by state legislatures across the country. I've been a state legislator for 20 years, and I have witnessed legislation that targets African Americans with almost surgical precision. That was a decision that came down in North Carolina. My district has been one that has been cited, and this is why I support the legislation. It is so very important. By having owners of public and federally backed housing units provide tenants with a simple reminder on how to register to vote with their new address, we can help lower the barrier to access the ballot for millions of Americans. I would certainly appreciate the support of the members in voting for this. And Mr. Chair, I do thank you, and I yield back.
The gentleman from Wisconsin, Mr. Stile, is recognized for 5 minutes to strike the last word.
Thank you very much, Mr. Chairman. As I review this bill, I think there's two key things that give me great pause. One is mission creep. The CFPB is a completely uncontrolled entity. We've talked about it many times in this committee, our opportunity to bring the CFPB under the control of Congress, to put their budget under the control of Congress. We continue to have a runaway CFPB that has very negative implications for a broad array of actions across the United States. Adding another authority under the CFPB to an entity that already is not responsive in any substantive way via budget process to Congress gives me very significant pause. The other concern that I have with this bill is actually quite substantive to the language in the bill. And so as noted, it seemed to attempt to build a bit on HR 1, was maybe included as an amendment in the HR 1 process. I want to make sure that it's easy to vote and hard to cheat. And in HR 1, if you look at page 51, line 11, amongst the broad array of bad ideas that are in HR 1, one of them that I think was in there just because really it was more of a drafting mistake than anything else, maybe wasn't thought through all the way, is when inside HR 1, page 51, line 11, encourage people to look at the auto registration, the automatic registration language in HR 1 puts forward an automatic registration regardless of voter eligibility. I think it actually puts a lot of groups at high risk to actually engage in voter fraud. So an individual that'd be otherwise ineligible to vote, say somebody that's not a U.S. citizen who obtains a driver's license, would be automatically registered. And I think would actually put that person at greater risk to commit a crime. I think it's actually moving ourselves backwards. As I look at this legislation, again, there's no check on voter eligibility. You can buy a house in the United States, obviously, if you're not a citizen of the United States. There's nothing wrong with doing that. But putting forward this in the manner that we are, I think causes the same risk that we're seeing in HR 1 as it relates to automatic voter registration from a national perspective. And again, it would be inside of an entity, the CFPB, that is not in any substantive way responsive to Congress. It gives me great pause. So it's both the mission creep and the underlying substance that I'll be opposing this legislation, Mr. Chairman. And with that, I will yield back.
The gentleman from Colorado, Mr. Perlmutter, is recognized for 5 minutes to strike the last word.
Thank you, Mr. Chair. And just a couple points, and I'd like to yield to Ms. Williams. I guess I appreciate the gentleman's, Mr. Stiles' concerns about mission creep with CFPB. I think that's kind of a fair comment. I disagree, but it's a fair comment. I think, though, for me, from Colorado, where we have automatic registration, where we've had just efforts to make it easier for people to vote, for people to have a say in their future through the polling place, through mail-in voting, through automatic registration. As a consequence, in Colorado, we are either number 1 or number 2 every year in the number of people who are eligible to vote who actually take the time to vote. And it has been a fantastic empowerment of Coloradans. And so I would disagree with my friend from Wisconsin on that second part. I can understand his initial concern and his initial pause, but I would disagree with his second. And with that, I'd like to yield to the gentlelady, Ms. Williams.
Thank you. Just to address some of the concerns, this bill does not give the CFPB more power in any way. What this bill does is allows them to give information to voters as they move. In my home state of Georgia, I see all the time people who have moved residences and being purged from voter rolls simply because they moved and forgot to update their voter information. This bill simply requires information to be given to them so that they know how to register. It's a gentle reminder so that they can register, but there is nothing that is going to change who they're going to register with. This is information. And I think that we should all be moving towards more information is always better. It does not give the CPBF any additional power than what they already have. So this is simply information. We should all be making sure that no matter where you live, no matter where you're moving to, people have the information that they need to register to vote. And so anyone interfacing with federal housing, tenants in public housing, tenants in HUD-assisted housing, tenants in properties with federally backed single and multifamily mortgages will get the information that they need to update their voter registration information when they move. And I yield back the balance of the time.
And I thank the gentlelady, and I just want to make a general comment to everybody on the committee, both sides of the aisle. We had a very heated Rules Committee hearing last night that went on forever, and Ms. Williams and I, together with Mr. Timmons, are on the Modernization Committee, and one of our concerns has been civility and general discourse as we debate these bills. And I just want to say to everybody, this has been the most civil, most high-level kinds of conversation that we've had, not so much in here, but I just wanted to compliment everybody on that. Don't make me wrong, Mr. Style. I yield to you.
If the gentleman just yield for one more, I would just like to note to my colleague from Georgia, I think it's a very laudable goal, and I share it, to make sure everyone has the information to be registered to vote. I think you and I shared time today on the Committee on House Administration talking about a similar issue as it relates to our elections. I think it's a very laudable goal and appreciate your efforts. I just personally feel that the location for this is misplaced. And so with that, I'll yield right back to my colleague from Colorado.
Reclaiming my time, does the gentleman from Missouri?
Thank you.
I yield to the gentleman.
I appreciate that. Thank you. I just have a couple questions. I mean, I think continuing to have the opportunity for people to have additional opportunities to vote and given the right information is fine. But we're creating something here with the CFPB that is very dangerous. Mr. Perlmutter and sponsor of the bill, how would you like one of the past Republican CFPB directors be in charge of your elections?
And I appreciate the gentleman's.
I yield back, Mr. Perlmutter.
I appreciate.
And I'm sure you know which one I'm talking about.
I appreciate the gentleman's rhetorical question, and with that, I'll yield back to the chair.
I recognize myself for 5 minutes. I support this important piece of legislation authored by my colleague, Representative Williams, that would provide voters who may experience a change in address with the information they need to register to vote. While egregious voter suppression tactics have been reported across the country in states like Texas, Georgia, and Florida, we must do everything possible to ensure that people have the information they need to exercise their right to vote. Particularly as housing instability has increased during the pandemic, we must acknowledge that each time a voter moves, they must update their voter registration information to reflect their change in address before they can vote in the next election cycle. We must also acknowledge that the frequency of moving tends to be higher for many low-income households and people of color. Evictions, poor housing quality, and the unavailability of housing can lead to more frequent changes of residences. As a result, households are less likely to have updated registration information, which can cause them to lose the opportunity to exercise their right to vote. Our nation's affordable housing crisis, ongoing housing discrimination, and residential segregation contribute to barriers to voter access. HR 355 will help reduce voting disparities, especially among low-income households and people of color, by equipping renters and homebuyers, no matter where they live or where they're moving to, with the information they need to get registered and exercise their right to vote. I urge my colleagues to support this legislation, and I yield back. Is there further discussion of or amendment to HR 3555? If not, the question now occurs on approving the amendment in the nature of a substitute. All those in favor say aye. Aye. Those opposed, no. In the opinion of the chair, the ayes have it, and the amendment in the nature of a substitute is agreed to. The question now occurs on ordering HR 3555 as amended to be reported favorably to the House. All those in favor say aye.
Aye.
Those opposed, no. In the opinion of the chair, the ayes have it.
Mr. Chairman, I'd like to request a roll call vote, please.
A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to Section C5 of Committee Rule 3, the vote on this question is postponed. The committee will stand in recess subject to the call of the chair. It is our intention to resume proceedings tomorrow morning at 10 a.m. The committee is in recess.